Hey guys, Frank Curzio here, and thank you for attending our Town Hall event, our first ever at Curzio Research. I really appreciate you guys tuning in. Wanted to hold this event because we're seeing pretty crazy times, and that's why we're even calling this "Navigating the New World Order." It is a new world, right? We're seeing GDP decline by 20%, unemployment's probably going to go down 35%. These are numbers we haven't seen since the Great Depression in the 30s. You're seeing not just states, countries on complete lockdown, economy shut down. And what do we see? We saw a market crash, and now it's come back considerably. And it's led to a lot of confusion. I have to tell you, if you listen to my Wall Street Unplugged podcast, I've been saying this for a while. I've been hosting that for 12 years. I know 12 years before anyone even knew what a podcast was. But uh, over the past month, I've been saying this is one of the most difficult environments I've seen in my 25-year plus career. And I could tell that it's tough for you guys as well by the questions that are coming in. And by the way, we have a Q&A at the end of this. So if you feel free to ask questions, we'll be covering lots of topics today, stuff that you're not reading in mainstream media, you're not seeing on TV. I promise I'm going to share so many different ideas for you, exactly how to position yourselves. Because remember, this is about your generational wealth. Okay, this is about the money you're going to leave your kids. It's not about politics because we're going to get into politics because it's a pretty big deal, right? We know that the Republicans want to see the economy doing great going into November. We have the Democrats. It would be better off if it wasn't, right? So again, I don't care how far left, right. This is about your money, and that's why I'm holding this. So any questions, you feel free to ask whenever you want. I'm going to answer them at the end, and then after that, I'm going to share my two favorite trades for you. Definitely listen up. My last trade was 3 weeks ago in Curzio Venture, one of our newsletters, and we're up 100% just 3 weeks on Nordic American tankers. Bought it below 3, and we sold it pretty close to 8. So we sold half of that position, locked in gains. Our cost basis is 0. But these are the opportunities we're seeing in this type of market. And let's get to this type of market. What does it mean? The questions that you've been sending in and the nervousness that I'm seeing, it's pretty crazy. And I understand that because there's one theme that I want to talk about today. Okay. And I'm going to be sharing charts with you. I'm going to be doing this off the fly. Again, sit back, relax, have fun. This is going to be as casual as could be. A normal town hall event, we'd have this in, a studio and bigger, but we have to improvise, right? Because again, it's a new world order. Things are different. So I want to start by bringing this up because I'm going to keep coming back to this theme. Okay. So when I share my screen here, I want you to look at, this is a chart of the S&P 500 forward earnings. Okay, forward earnings. This is the S&P 500 earnings, all the companies combined, and adding those earnings together, based on that, where the S&P is trading, we're trading at 22 times forward earnings. Okay, so to put that in perspective, we were trading at 19 and a half times forward earnings before all this started, before the market crashed and then came back. Now, when I look at this and see, let's go 3 years. I have some fun with this. Let's go 10 years. Look where we're trading. All the way up here, right? Our highest valuation ever. So guys, what does that mean? We're under the impression that things are going to go back to normal. I'm going to show you today why they're not going to go back to normal for a very, very long time. Not by next year, not in 2-3 years, maybe even longer. But when we see the S&P trading at this valuation, it's not telling us in a year from now that we're going to go back to normal. It's telling us that we're going to see the best conditions we've seen in the history of the markets. That's pretty crazy when you think about it, right? So that's going to be the theme of this. Now, I've been fortunate doing this for such a long time. My late dad was an amazing value investor, 25 years. I learned so much from him. Just incredible when it comes to balance sheet, income statements, modeling, and stuff like that. He also managed money. And then I learned from Jim Cramer as well. So Jim Cramer for 5 years, which is a long time. I'd say the average research analyst lasts about a year and a half. But I respect Jim. He's a friend. He's been to my wedding. And that helped me learn about growth, right? Which I was fortunate. I was very lucky to learn about different styles of investing, of growth, of technicals and value, and combining that. And, by using that, we were able you're looking at the growth engine of the world is China. They're completely shut down, and we're trading at 19 and a half times forward earnings going in. So that's why we're sounding alarm and saying that to take profits, and a lot of subscribers followed us and did very well. But now the markets have come back tremendously, and I don't want to talk about the past. Okay, the past is over. We want to talk about what's going to happen now, what's going to happen in the future. That's what this is about. That's why I'm holding this event. Now, I want you to use your common sense here. because forget about everything else. And by using your common sense makes you smarter than most economists who lock themselves in a room and look at pie charts when the economy is about people. It's about how much you're paying for milk, the electricity bills, jobs. What are you seeing with your neighbors? And you have better access to that to real time than anybody else just by paying attention, by looking around. And when I look at this situation, people tell me things are going to go back to normal. I want to present something to you. Okay, this is pretty easy. So I've got a lot of questions. It was great getting those early questions, and one of them was funny. Do you think the NFL they're going to play a season without anyone in the stands? And they may, but if you're looking right now at TV, what are they arguing about? Georgia opening up early. By the way, Georgia's a stone throw away. My daughters actually go to gymnastics in Georgia, 20 minutes away. I live in Florida, the border between the East Coast, and they're also talking about politically too. Is what's going to happen with these markets when we open up? We're going to see a huge rise in cases with the coronavirus, and you know what? That's correct. We are. I mean, that's pretty much a fact. We have everybody on lockdown right now, right? So it makes sense that you're going to see infections go lower. It makes sense that you're going to see death rates go lower. But it's not really addressing what's going on, because what we want to pay attention to is what's going to happen 6 months from now and a year from now. That's why I'm bringing up this football example, because when it comes to football players, it's one of the closest contact to contact sports where the offensive line, the defensive line is this far apart, guys. So when you're just this far apart, I mean, you're sweating, you hand the ball off, there's going to be people on top of you. You're going to be talking trash in people's face. To think that no one's going to get the coronavirus, or if one person gets it, what do you think is going to happen? I mean, they might shut down the NFL, and that's likely to happen. But according to where stocks are trading, everything is perfectly fine, and we're normal. Now, let's put that into perspective, okay, and dig in a little deeper. Because when it comes to the NFL alone, I'm using this as a small example here, guys. You're looking at stadiums generating less money. They're going to start removing seats. And that means less money to owners. That means less money to pay players. Fewer people going to the games. What does that mean? You have less oil and gas being used. You have fewer people taking Ubers to games. Tailgating, is that going to exist? A ton of money spent on tailgating. Don't think about just your favorite team. This is going on in the U.S. and around the world. I mean, all the food that goes into that. And you're looking at companies, the beer, right? We all like to drink beer during these events as well. Anheuser-Busch, Molson Coors, Heineken. You're looking at Coke and Pepsi, right? Again, we're looking at it. I'll bring up the chart again, guys, because I'm going to keep coming back to this theme right here, right? We're trading at a valuation that suggests everything is not just going to go back to normal, but be great, right? So let's take a look at this right here, right here. So this is where we're trading. This is a 10-year chart. So when we're looking at this and suggesting things are going to be normal, right there, you're going to see declines. And how many companies did I mention? Now, you want me to go forward? Just with this example, I mean, less people in the stadiums means what? It means that you're going to see fewer people buying jerseys, right? You're going to see fewer people. That's Under Armour. That's Nike. These companies are going to be impacted. I mean, how many times you go to buy a jersey when you're at a game and you see these lines? Those lines are gone, right? All the food that's being offered inside, whatever it is, Constellation Brands, Nathan's, the meat company, Smithfield, Tyson, Dean Foods, a lot of these companies. You're looking at broadcasting rights. And this is a huge money generator for most of these companies, where Disney and you have, with ESPN, no live sports right now. You look at CBS, TNT, which is owned by AT&T, NBC. You're looking at these projections of what happens. This is crushing people. And I don't want you to think I'm just spilling off stats here. I'm going to show you a lot of stuff and a lot of evidence of what's going on just right here. An analyst, this is how much they're losing just from the NBA, guys. Just from the NBA, that's how much they're losing, right? So, I mean, how many companies did I name right there alone? Because when you're looking at this and you're seeing a decline in profits across the board, it's going to lead to more layoffs, right? So, and that's common sense. Now, this is just one small part. What about social distancing? Look at restaurants, guys. With restaurants, if you're going to eat at your favorite restaurant, they're going to take tables out, at least 10, 15%, right? The capacity. You look at restaurants, that 15% in revenue is the difference between going bankrupt and staying open for a lot of these companies. You look, are you going to go to a Disney park pretty soon? Probably not. Are you going to sit on the middle seat in an airplane anytime soon? Probably not. So again, when I look at this theme and I see this and people think everything's going to be back to normal, you know what? It really scares the hell out of me here. It's pretty crazy to think that. Now, that's one tiny little itsy bitsy example. Okay, now let's talk about the risks. And I'm going to break these down as quick as possible for you, okay? 1 year from now, again, use your common sense. What's going to be your relationship with China? I mean, China closed Wuhan in January and even a little bit earlier than that. But they closed Wuhan and said, we're not going to let anyone travel outside of China, from Wuhan or inside. But you know what we're going to do? We're going to let people from Wuhan go international and travel whenever they want to and from, which spread the coronavirus everywhere around the world. So there's going to be a huge penalty to pay for China. And you're looking at tariffs being raised. And I'm a guy that said, listen, ignore tariffs. The U.S. was in a great spot. We were fine. We were great. China was not. They were going to have to comply. And, again, they were going to fight us as long as they can. But at the end of the day, that worked out. It's a different scenario. And you have to be willing to adapt to this environment, guys, because it's always going to be different depending on what the government's doing, who they're bailing out next. You got to be willing to change your thesis. You can't be, like those gold bugs who since 1970 just, the dollar's going to crash and buy gold, right? I mean, you could see them every 15 years and it's the same thesis. No, your thesis could change in a week. I mean, do the cruise lines going to survive? No, they shouldn't. But if the government comes out and says we're bailing all of them out, then it's a different story, right? So China, our relationship, China is the growth engine of the world. It's the reason why we're trading at such a high multiple. And now we're trading at even our biggest multiple in 18 years, the highest for the S&P 500. So, what's going to happen with China where, 40% of the world's growth, that's what it accounted for in 2019. That's going to be cut off. Things are going to be different. What about Europe? Europe was a complete disaster. Nobody even talking about it. I mean, you're looking at the top economies in Europe. And, if you go to Spain, you're looking at Italy, you throw UK in there, you have Brexit. France and Germany account for about 70% of that GDP. Almost every one of those countries within Europe were borderline recession pre-coronavirus. Again, so even when you look at our international growth, where over 30% of our profits in the S&P 500 come from, look at Europe and China, which depend on the U.S., which we've been closed for their profits. I mean, you're seeing a global recession to the likes we haven't seen since the Great Depression. But everyone says a year from now, things are going to be fine. We're going to be cool, right? This is what I want you to think about is what's going to happen a year from now. Because if you use your common sense where companies are cutting CapEx across the board by 20%, what does that mean? CapEx is capital expenditures. That's what they use to upgrade their plants. That's what they use for M&A, mergers and acquisitions, to take over companies. This is a pure growth thing. You're looking at these companies cutting their marketing budgets by 25%. Google said they're cutting by 50%. Expedia said they spent $5 billion last year. They're only spending $1 billion this year. What happens when you cut marketing? For all you business owners out there, come on, it's pretty easy. You cut marketing, you're cutting CapEx. You're not going to generate more revenue than what you generated the year before. It's not going to happen. So again, we're assuming things are going to be great. Unemployment rates already at 17%. By next year, do you really think we're going to go to 3.5%, 4% unemployment? No. Are you crazy? Right now, people are making more money on unemployment than they were when they had their jobs. It's going to be hard to get these guys back to work. So the unemployment rate is going to be a lot higher. That's fewer people are spending money out in the markets. Buybacks were a huge part of this growth for 10 years. In the market, I mean, you're looking at $1 trillion in buybacks was expected this year, right? That's what we're approaching on an annual basis. So when I'm looking at these companies, when that's gone, and by the way, half those buybacks are financed by debt. We had low interest rates. What does that encourage? That encourages leverage. So when we have this type of leverage in the marketplace, what does it mean? It means that a lot of these companies weren't pricing in a 60, 70, 80% decline in revenue. Nobody does, but now they're more leveraged than they ever been. And we're seeing that. That's why we're seeing all these bailouts. What happens if Biden gets elected? I have nothing against Biden. Again, politics aside, what I do know, if Biden gets elected, our tax rate has gone down to 35% to 20%, the corporate tax rate, which was huge. That generates lots and lots more of earnings, creates more jobs. What is he going to do? We're probably going to go down to 20, 25%. If that's the case, forget about the 22 times we're trading at now. We're really trading at over 30 times forward earnings, which is even crazier. Oil. I mean, you're looking at oil. Again, these are all the risks, guys, that are going to, a year from now, if you think about it, I'll bring it up again. I want this to be the theme here. where the S&P 500, and you're looking at this, and where it's trading, of how high, well, not assuming down here that everything's going to go back to normal, but things are going to be even better, right? That's what we're saying right now. When I'm looking at oil, I mean, oil's a pretty crazy market. And just my question is, with oil coming down, and by the way, oil prices fell by 267% in one day. I'm pretty good at math. I didn't know that could happen. So, but my question is, if everything's going to be back to normal and so great, if you look at oil and you look at the forward contracts, which is what is trading in the future, and you're looking all the way out to 2022, early 2022, oil is trading those contracts at under $35 a barrel. Our producers, our shale producers, can't produce at less than $45 a barrel. So if our economy is going to be so robust and so great and the best it's ever been, why wouldn't oil be trading at $55, $60, $65? Okay, so the evidence is showing us. Now, I know it's hard. You're looking at a market right now, guys, and you say, wow, this thing's going up. Don't worry about it. We're in a market where you're encouraged to remove your guidance. You almost get rewarded. What does that mean? Companies, when they report earnings, they give guidance of what they're going to earn next quarter and what they're going to earn for the rest of the year. Now, pre-coronavirus, if you cut your earnings or you lowered your guidance by, say, 10%, 15%, your stock got nailed. Your stock got nailed about 10%, at least. If you removed your guidance totally, you would get nailed by 20%. I'd say 90% of the companies in the S&P 500, even some of the FANG names, have removed their guidance, which means what? They don't even know what they're going to generate. So it's not that they're projecting, oh, you know what? They're throwing a number out there where, sales are going to go from, 100 billion to 80 billion. They're like, it could be 80, it could be 60, it could be 30 billion, 20 billion. Yet we're going to go up on that. So I don't want you to get caught up with the markets and what's going on right now, which is craziness. But you do have to worry about a lot of the risks in the marketplace. And guys, I mean, these are just a few of the risks here. I mean, look at when I'm looking at Kim Jong-un. I mean, right, North Korea. When I wake in the morning, in my life, my goal is to be a great dad, to really serve my subscribers, to make my company better. For North Korea, their goal is to end mankind, right? To end mankind. And we don't know whether their leader is alive or dead right now, who's taking over. That's not even a blip on the radar right now. That's how crazy of a market is. Nobody even cares. I mean, without the coronavirus, that would be headline news for weeks and weeks and weeks, trying to find out intelligence of what's going on there. But that's how crazy, I look at this market. Where is everything going to go back to normal? I'm not betting on it. When people tell me vaccines, Frank, what about the vaccine? I've talked to leading infectious doctors. I've covered this extensively. No, I'm not talking about Dr. Fauci, which, by the way, everybody's relying on the numbers. It's kind of funny because our numbers are all wrong, right? All the governors, the data, we're going to let the data tell us when we're going to go back and whatever, right? If you're looking at the data, it's been wrong. If you look at Dr. Fauci, who I admire, again, he's very favored by both Republicans and Democrats. I love him. I think he's doing a great job. But look back at what he was saying in early January. We're okay, and that's not going to spread to the U.S. I mean, you have Andrew Cuomo, mayor of New York, saying that, hey, I don't mean to be arrogant. We're New Yorkers. We're not going to be impacted like other countries. Well, guess what? New York, you had more infections than any other country. Right. And then you have the president saying the same thing. We're going to be okay. Again, politics aside, these guys care. I don't care who you hate, who you like. These guys are trying to save lives and they're adapting. But the point is, when you're looking at the numbers, they're all wrong. We're not testing enough people. I mean, you're looking at, hey, let's open up the economy. Everything's going to be fine. Well, what happened to Singapore? I mean, we praise Singapore for saying, hey, you know what? They closed. They did it right. Look at them. They're open. They opened up. They have more cases now and they shut their economy again. What do you think is going to happen? Do you really think that the coronavirus is gone? We're going to put more people into the population getting closer to each other? Do you think that's gone? Absolutely not. So when I look at these risks, and one of the biggest things is vaccines. Frank, what's going to happen when we get a vaccine? Again, I've done so much work on this. I'm going to let you know a little stat. The earliest and the quickest that we developed a vaccine in the history of the world, 4 years. 4 years. And that was mumps 1967. Granted, we have a lot more resources, more companies working on this than ever, almost the whole pharmaceutical biotech industry. I get it. To assume that we're going to get something within 18 months is absolutely crazy. And if we do, I don't know about you, I'm not taking it because there's not going to be enough testing to go to see what these risks are. And you know what? People hate taking things. If you have a disease, it's fine. But you're taking something when you don't have a disease that could impact other parts of your body. You don't know. So, all these stats coming out in Gilead and there's no control groups or anything. I mean, you need control groups, but the vaccine itself, say if I'm wrong and in 12 months from now they come out with a vaccine, or 9 months, and that's the best thing. Well, if you're looking at the flu, we have a vaccine for the flu, right? Again, I'm not just shooting numbers out over here. So let me bring this up for you. Okay, what site is this? This is CDC, Centers of Disease Control and Prevention. We're looking at 35 million people. 35, this in estimate, 35 million people, 2018, 2019, guys. 35.5 million people got the flu, and there's a vaccine for the flu. So a lot of that doesn't even work. And we have vaccines for the flu every single year. Most of them don't. So to assume that once we get a vaccine, that's it, this virus is gone and we're cool, it's not that easy. So where am I getting to with all this? The risks in the marketplace are crazy. We could see a considerable downturn. It may not happen during earnings season yet. Companies are getting rewarded for, look at Chipotle. Chipotle reported, and their stock is trading close to an all-time high. Their same store sales, which are stores open more than 12 months, stay with me here, were increasing over 30%. Analysts lowered those estimates because of coronavirus to 13%. They reported same store sales growth of 3%. The stock went right near its all-time high. Does that make sense? Well, they're kicking, you know what? They're kicking butt. They deserve to get a premium. I get it. But when I'm looking at a company like that, where they said, well, our digital sales are through the roof. I love Chipotle. I eat there twice a month with my family. And over the past 2 months, when I called there, they said, well, too bad, you got to use our app. That doesn't result in more sales. So you have digital sales up 80%, but if you look under the hood, it's close to 75, 80% of those customers, they're already customers. It's not new people coming to your stores. Sales are down. Should the company be trading at its all-time high? I mean, use your common sense. If that's the case, Chipotle should hope that their stores remain closed forever and the coronavirus lasts forever. If you're doing that, great. Again, when I say their stores are closed, they're offering takeout, but most of their stores aren't open. You're going to see them open soon. But how could that company be trading at a higher valuation today than it was when your stores were officially open? And that's where we're at right now. So one of the most dangerous markets that I've ever seen, pretty crazy times. And for this broadcast, I wanted to cover the sectors, the places to invest, because it's not everything that's going to get killed. It's not everything that's going to get killed. There's certain things that are going to get killed and certain things that are going to thrive because this is a new world order. So sectors are going to outperform. If you're looking at software, of course, Microsoft's, Oracle's, Adobe's on a large cap. Companies with conferencing software, Zoom, Google with Skype, or Microsoft with Skype, Google with Google Meets. Cloud. I mean, cloud is incredible. Where Amazon, Microsoft, Google, IBM, one of the few companies in this market to raise their dividends, other than shippers, which are doing it, and a few other food companies. Retail stores that were allowed to open during the coronavirus. The Walmarts, Targets, Home Depots, Amazons. Guys, I know they ran up, but they're gaining incredible market share in the rest of the world right now. And when these other stores open up, are you going to go to get your whatever? If it's food, just the necessities, I'd rather go to the Walmarts or Targets because they're already established. They have, it's a much cleaner environment. They've been through this. Now they're separating lines and making you come to one door. That's what they're doing in Florida. But these are the companies that are gaining market share. That they're hiring tens of thousands, hundreds of thousands of employees. Food delivery services, the Grubhubs, right? We thought those companies were worthless. The Blue Aprons, the Weight Watchers, right? Great earnings. Roku. I mean, I'm going to talk about streaming in a minute when it comes to Disney. Roku is a company that almost like a royalty company that doesn't have to worry about spending tons and billions of money on new content because streaming is a horrible business. It's great for you. It's great for me. But, people are rushing into an industry that has very little pricing power and costs a fortune to operate, where outside of Netflix, and not even Netflix, if you look at Netflix cash flow numbers, they're horrible, but it's a very difficult business to sustain. But, Roku avoids a lot of the negatives in that industry. Shopify is another name. Gold. I mean, is the government going to stop spending money? $750 billion just for small business loans? Guys, just to put that in perspective, TARP was about $475 billion. This is just for small business loans. And you're looking at airlines. We gave them $25 billion. What's that going to do? I mean, they generate $300 billion in sales last year. What's $25 billion going to do? So pretty crazy times. But when you look at gold, if gold doesn't go up now, and again, I know probably the biggest gold bugs out there. If gold doesn't go up now, I don't think there's any reason to ever own it ever again. But just the amount of money that's being spent, you're seeing a lot of gold stocks go higher. We have leverage to gold. You should definitely have leverage to gold and also have leverage to Bitcoin. And guys, you get a chance, listen to Wall Street Unplugged. Tom Lee, one of the biggest, one of the only institutional guys that cover Bitcoin. He's very controversial, but we had a great conversation. Again, that was yesterday. If you want to listen to absolutely for free on iTunes. Bitcoin, it was created for this environment as well. And you're going to hear some really great pointers from Tom of why he thinks this is going to go a lot higher. Those are the sectors that are going to be okay. Let's go over some of the things that aren't going to work, right? These are a lot of questions that you're asking. Travel, pretty obvious. Airlines, the Boeings, the Deltas, Americans, United, don't forget. Boeing, I went to their facility. Please, you should visit their facility. It's unbelievable. It's the biggest manufacturing facility in the world, Everett, Washington. What I noticed is hundreds and hundreds of suppliers. It's like a big assembly line for jets. It's amazing. And a lot of the suppliers are going to be hurting. So, you look at Hexel, United Technologies, Ducommun, BAE Systems, online travel sites. I mean, how many people are booking on them compared to when even a year from now, these things going to do good? No, not really. I mean, travel is going to see a significant decline. The Expedias, the Priceline, which is called Booking Holdings. The social gathering, any companies, think of Dave & Buster's. I mean, Dave & Buster's is such an amazing company. They found a way to for people to spend $150 when they're there to play video games. But you're playing video games. You have your hands on video games. The joysticks, whatever, basketball. I mean, that's a German-fested, forget it. I mean, that company, it's hard to see how they will survive. I hope I'm wrong. I mean, that company was doing fantastic. The Six Flags, the Disney's, the parks. I mean, how many grandparents? I mean, I live in Florida. I love Disney. Yeah, the annual pass, but that's going to be real tough as well. Live Nation, AMC, theaters, IMAX, car manufacturers as well. Ford, GM getting crushed. Huge leverage with these companies. Rental cars, Hertz, Avis. You're looking at REITs. I mean, the malls are going to open up and everyone's saying, wow, the malls, they're going to start generating revenue. That's better when they didn't. But, when your stock price just went up 40, 50%, is trading 15, 20% off their all-time highs, a lot of that is factored in. You're not factoring in that they're just going to open. You're factoring in that they're going to generate, tons of revenue. And they're not. They're just going to start to generate revenue again. And they have to open before all these stores open. Retailers, casinos, I mentioned earlier, fewer slots. I mean, when I look at some of these things, it's pretty scary out there. Now, I want to cover something for you, and I'm going to go through this really quick. I want you to pay attention because I'm going to take two companies. These are the biggest companies, right, in their respective industries. And I want to talk about Disney first. Okay, so when I look at Disney, and I'm going to bring up a report here. Okay, this is a sell-side report that I'm going to bring up. Okay, and this is from Wells Fargo. This is from April 7th, right? And I want you to see. So I'm going to increase the size of this. Okay, I love doing this stuff on the fly. But I want to show you this because it's very important, okay? Now, these are 2019 estimates, right? This is what Disney was supposed to make right here, $5.77. Look what they're supposed to make next year, $2.66. This is where Disney is trading. This is their forward estimate, 38 times forward estimates, right? What's even better is everyone says things are going to be fine next year. Well, if they are, look at this number. They actually put holy you-know-what here. So $2.42 in earnings, meaning it's trading at 41 times 2021 earnings, right? And Disney may be the only company I know that's projected to generate, right? We're expected a V-shaped recovery, right? So 2020 bad, 2021 is supposed to be great. That's lower earnings. All right, let's dig a little further and see what this means, okay, guys? Because I'm going to really dig in here and just show you some numbers because this is Disney. Now, let's bring up this chart right here, which is really cool. So this is the forward PE of Disney, right? This is 1 year, right? Here it is. There's 45 times forward earnings, gone up since that report. Let's have some fun with this and go 5 years. Let's go 10 years. And again, this is going to take a little bit, but look at this line right here of where Disney is trading. Disney's trading at the biggest growth multiple is traded, and you can go back for 30 years. 30 years, the history of the company of where Disney was trading, and people are buying this stock like nothing. Now, you may say, well, maybe they deserve a growth multiple. Okay, well, the market usually trades, and by the way, let me show this to you right here, because this is also important. I'm going to bring this up, which is really cool. So I showed you this is the S&P 500 where it's trading. Look at what the average is over the past 10 years. This is a 10-year chart. About 16 times forward earnings. Look where we're trading at a monster premium, much, much higher than we ever were. So when I look at Disney and getting back to their report, I want to show you something else. Because a lot of people like Disney in this market, which I think you're absolutely insane. Let me shrink this a little bit. Go down. And when looking at this, so dividend possibly under consideration. Okay, dividend, they're probably going to have to cut their dividend. Now, people say, well, streaming is a great business for this company. Follow me here. I'm going to just bring this up really quick. Okay, if you could see this, this is Disney Plus right here, right? Now I'm going to scroll down here. This is Disney total Disney revenue that's expected, okay? This is 2024. Stay with me. Look at this number. They're expecting 154 million subscribers by 2024. It's probably going to be higher, right? They've been beating the estimates. I'll increase this for you. Make this a little bit bigger so you can see it. 154 million subscribers, right? Put that in perspective. Netflix has 170 million right now. And they say they're going to generate, that's the revenue, right? Total revenue of $5 billion, 5.4 billion. That's pretty cool. But you have to look at the whole thing here because when you go down, you see total Disney costs. It's almost break even at 154 million. Now I'm using a report this way. This isn't just me shouting out estimates. So let me ask you a question with Disney, right? You're looking at Disney. Do you think Disney is going to be significantly impacted? I mean, if you take out streaming, which everyone's so high on, again, streaming is one of the worst businesses in the world. It's almost like the Lakers are going to let everyone, for $5, you can go there and shake LeBron James' hand every single game. That's great for you. That's great for me. That's not great for the Lakers, right? It costs them a lot of money, and I'm sure LeBron would never do that. But when you're looking at streaming itself, it's tough business. It has no pricing power. Yet Disney, what did Disney do? It gets even better, guys. So Disney, right here, stay with me. So Disney, this is their debt structure. It's a summary. Don't get nervous. I'm going to break down a couple of numbers for you. This is really important. Okay, let's make this a little bit bigger here if we can. Okay, so you're looking at total debt. Look at this number, $20 billion, right? This is 2018. Look where they are now. $52 billion in debt. I mean, their net debt position of $45 billion, more leverage than they've ever been in the history of the company because it went all in on streaming. They paid $70 billion for Fox Entertainment assets last year, right at the top of the market. So net debt means they have $7 billion, not $7 billion in cash. Now, you're looking at a company right here. This is their debt schedule that has to pay like a $7.5 billion payment this year, right? 1 year. It's due in 1 year. $7.5 billion. Throw in another $3 billion for your dividend. $10.5 billion. $7 billion in cash. I mean, when I look at Disney, guys, it's incredible because they're going to have to suspend their dividend or get rid of their dividend. I mean, it just, when I'm looking at the fundamentals of this company, it just doesn't make sense. And when you're looking at and bringing this back up again, guys, where the valuation levels is just incredible. So you're looking at this and bringing this up again to see where it's trading over 10 years. But guys, more important, look where this the average Disney trades. The average Disney trades 17.5 times forward earnings. Look where it is. Does it deserve this premium? Do you think Disney deserves this premium when you take out streaming, but a park's going to go back to normal? The theater's going to go back to normal? You're looking at Hollywood? You're looking at Broadway? I mean, Disney's more impacted by this and social distancing than anybody else. How does this company have a forward PE of 40-something when it should be lower than the overall market? It should be around 17 times. So it's incredibly overvalued. This is a really scary, scary company to me. Again, not anything against Disney. I go there with my kids. But this company could easily be cut in half and still be expensive right now. And again, we're taking 2022 estimates, even looking out that far, which is crazy. Now, speaking of forward earnings, I wanted to provide you this chart right here. So I did a screen of companies in the S&P 500 trading above 25 times forward earnings. Now, I'm trying to figure out why any company at all would have a multiple that's higher than the market. I mean, it's much, much higher than the market. So these 143 companies, the S&P 500 that I screened for, look at some of the names on this list that I highlight. These are all trading at above 25 times forward earnings. You want to buy Chipotle at 95 here? You want to buy Las Vegas Sands? News Corp? This is forward earnings. Advanced Micro, they just came out. They were growing 40%. They said, well, now it's only 25%. It's going to be less than that. This company's trading at an astronomical valuation. It's a hardware company. Nike, 35 times. Visa. I mean, look at these numbers. VF Corp, 30. Look at all these great names. Of course, the FANG names are on this list, and maybe they deserve it. But, guys, you're looking at a market that's just, it's going to correct, and it's going to correct sharply. And I want to bring up one more example for you guys. And this is the largest company in the world, which is Apple. Okay. So let's start bringing up Apple here. And I want to show you a research report. So this research report right here is from Goldman Sachs. And Goldman Sachs, very, very rare, by the way. And this just came out. This is from April 16th. Very rare when you see the largest company in the world here actually have a sell rating by the largest investment firm. It's very, very rare. But you're looking at Apple here. I mean, look what they're modeling for. So 36% drop in iPhone sales, iPhone units. Here's a company that's trading at 25 times forward earnings. So look at that $11.42 number. Okay, I want to get back to that. Not to mention they're saying average selling prices, which is margins, are going to be lower. But let's dig a little deeper here, really quick. So we're looking at Apple, looking under the hood. Few people know this about Apple. From 2018 to 2019, look at earnings. Earnings declined year over year, and revenue declined year over year, right? 265 to 260, 1191 in earnings to 1189. They declined year over year, yet Apple was trading at its highest valuation going into this, right? Why? Because they're expecting massive growth in 2020, 2021. Now, when you look at this growth, they're projecting, and you're looking at Goldman Sachs, I'll bring this back in here. I mean, you're looking at 1142 in earnings now. This was like a $14 number. This was a $16 number. So they're expecting massive growth 2021. This is supposed to be a blockbuster year. 5G was coming out. Everything was coming out. It was great for Apple service revenue. Now you're putting that off. So why did they deserve a 25 times multiple in trading at that level? I mean, you're looking at Apple. Do they really deserve to be trading at their most expensive valuation ever? Does Apple deserve that valuation, right? They're probably more impacted than most companies, right? I mean, the supply chain is in China. Yes, the supply chain is going to turn back on, but now it's a demand side problem. Think about Apple. I love their products. Here's the Apple iPhone right here. I love it. I have iPads for my kids. It's a great company. So is Disney. I'm talking about valuations here. If you like a Snickers bar, you're not going to pay $25 to eat it, right? It's about valuation. Should Apple be trading at its most expensive valuation in the past 10 years when the supply chain is certainly disrupted? Who knows if the 12 is going to come out on time? Again, the numbers that they just reported, but you're looking at a company that's significantly impacted where maybe U.S. people stop buying these phones, and I get it. That's fine. But in Europe, that's their growth model. Europe, their growth model consists of China. I mean, companies and countries and people that are on unemployment, for Apple to really say that they're going to do as good as they did ever, right, in history, right, it is pretty insane. So bringing this all in, okay, and I don't want to provide too many numbers for you guys. Again, I'm doing this off the fly, so I try to keep it short and sweet. We're in one of the most difficult market conditions. It's going to be extremely dangerous. You're seeing stocks go up. Even over the past couple of days, you've seen a lot of the garbage go up. You saw, stocks that got hit the hardest, that are going to be impacted the most, which is casinos, oil companies, travel companies have gone up 15, 20%. And there's that FOMO, the fear of missing out. You got to try to not watch as much TV, right? Because if you're looking, and again, using your common sense, guys, we have fundamentals, we have technicals. In a year from now, do you really believe that everything's going to be okay? Do you think that everything's going to go back to normal? Because again, we're pricing in that things are going to be even better, the best conditions that we ever had in history of the United States. I don't see it. Now, 2 years ago, I created a product called Money Flow Trader, and it was based on the market coming down because we just went through one of the biggest bull markets ever. And I was 2 years too early, about a year and a half too early. But what I wanted to do is bring Wall Street to Main Street and show individual investors how to make money on the downside. And I'm not talking about shorting, because if you short a company like Tesla, which again, I'm not picking on anyone, a lot of negative opinions on Tesla, people shorting at 300, 400, 500, 600, 700, all the way to 800. If you're wrong on that, you're going to be sleeping in a park and you lose your house and everything. I'm not talking about that. I'm talking about using conservative option strategies like puts, long dated puts and buying long dated puts for a year. And if you do that, you're not worried about what happens in the short term. What you're looking at is a year from now that a lot of these names are going to get hit. I provided Apple and Disney for a reason, guys. I showed you these names because they're household names. It's not that I'm cherry picking different. I wanted to take two big industry leading names because if you could see those and where they're traded and what's going on with this market, think about what's going on under the hood. It's pretty crazy times. You're going to see a lot of downside in this market. And with Money Flow Trader, it's one of our best selling newsletters right now. It's been doing fantastic. It's run by Genia, who's an option specialist, just someone I'm honored to have on our staff that's been doing a fantastic job on the way down. The winners that she's had have been incredible. And, there's a way up, but a lot of these things and a lot of her recommendations, this is a way to generate 2x, 3x, 4x if you're right. If you see a 20, 25% decline in many of these names, and I'm not even talking about if they retest their lows. That's more of a 40% downcline pullback from some of these names that have gotten the way back up again. But, during these times, you want to protect yourself. And I wanted to bring in Genia right now. So I'm going to bring her in, and we're going to do a special interview just with her, which is really exciting. Again, getting this technology right, but let's see if everything goes smooth here. Here we go. Let's get Genia in, interview her, and talk about Money Flow Trader. Genia Terranova, thanks so much for joining us tonight in a live webinar, first ever. Really appreciate you coming on. Thank you so much. How's everything going?
Everything's good considering the market and the virus, but holding on.
No, it's great stuff. Well, so this is the first time, not even guests are seeing you here, new guests, but even your subscribers probably seen you maybe for the first time. I've interviewed a lot of my Wall Street Unplugged podcast, but why don't we start by talking a little bit about yourself, which is always hard to do, but give us a little background, your experience, and this way people can learn more about you before we really get this thing started.
Well, of course, first of all, glad to be here. Glad to see you. Glad to see all of you. And let me tell you a little bit more about myself. I came to this newsletter prepared for the challenge. I edited several newsletters. Some of them are for income. For example, I've edited the Daily Paycheck. I run the award-winning Leap Income Performance, and I also wrote a column for the Complete Investor and the Value Income column for that newsletter. But it's not just the income that I was doing over the years. I've did much more aggressive newsletters. I edited for 3 years. I've edited Game Changing Stocks. I was editor for Fast Track Millionaire. And for a few years, I also ran an online-only options newsletter called The Aggressive Trader. So that, in addition to managing money, I think that was all of that experience has come together now.
I love your humbleness. I mean, I really do love it. Being like, well, I did this. I mean, the experience that you have is incredible, and the job you've been doing is awesome. So let's get to the option part first. I created Money Flow Trader 2 years ago because the market was really ramping higher since 2011. I knew it was going to be a time when this market came down. No, I didn't know it was going to be something like this, right? Nobody could really predict it. It's the first time something like this has ever happened in the history of a country where everyone's on lockdown. But I was a couple of years early, but now this strategy is working where I wanted to teach investors and have the editor of this product, Money Flow Trader, teach investors how to make money on the downside without taking on a ton of risk. So with that said, let's get to the strategy in newsletter, which is long dated puts, but explain the difference between what you're doing when it comes to puts and compared to just shorting outright.
Good question. So if you want to express or benefit from your negative opinion on the stock, you basically have two options. You can go short or you can buy put option. If you invest in a longer dated put option, you can only risk the amount you put in that trade. Either, let's call it a premium. Every option has a cost, and that's the maximum you can lose. When you short a stock, your loss is unlimited. Tesla is a great example. Had you shorted it at 350, you would not just be losing money. you would be sitting on the potential to lose much more because the stock just keeps going and going and going. So it's literally an unlimited loss potential. Had you bought a put on Tesla, yeah, that might have been painful, but all you could have lost was your premium or cost of that option. That's the difference.
No, it's just crazy when I see
Why we're
Tesla.
going,
Tesla's a
yeah.
good example, right? I mean, Tesla is there's so many people that always short the stock. We saw that everywhere, but it is a good example, an extreme example of why shorting could really crush you because, again, you're going to get hurt a lot compared to just losing a little. Now, when we say options here, right? When any individual investor hears options, that little red flag goes up. Oh, I don't want to learn this. This is crazy. This is nuts. So I wanted to explain to people how easy it is for the strategy you're using, and I wanted to take them through this. If you can do this for us. So we wanted to walk you through an option order here. This is an E-Trade account that we set up for you guys. But Genia, why don't you go over just like a dummy trade, something that you would put in, how easy it is to actually put a trade in once you give these instructions to your subscribers.
Of course, this is actually very easy. So you are on your E-Trade page and you've selected the options page, which is where you should be. Now let's go and put a trade in. Let's say we want to trade a put on Microsoft. So we start with entering the symbol, double check. Yep. And next, choose the strategy. This time around, we're going to go for a put. Let's stick with the quantity of 1. And we're doing a buy to open, which is what you do when you initiate a long put trade. We're going to change that expiration date because in our imaginary example, we want to go at least 8 months out, which is going to be January 15, 2021. That's January 15, 21. That's the one we want. And let's say we want to bet that Microsoft will decline to 100 or lower by that day. So we're going to strike of 100. In fact, it needs to be under 100 for us to make money at expiration. Double check, that's a put we're going for. And now the bid-ask spread shows you that you can buy it for about 211. And now all you need to do is to select the type of trade, which with Microsoft you can easily go with the market, but traditionally limit is a good way to do it with options. I will provide you a limit price as well. And of course, you need to do it good for the day. You don't want to do anything else with options because price changes so fast. That's it. That's all you need to know. That's all you need to do.
And right that 211 is the money you could lose on this trade. Again, it's just one contract here, but and you can go more contracts. But this is what you're risking here. And then again, you'd hit preview. We're not going to execute this trade here, but you're looking at here's the option trade. So basically, you're looking at Microsoft trading at 170, and you're betting for it to go to 100. Of course, Genia, that's not a real trade. I know a lot of people long Microsoft, and Microsoft's a good stock in this environment. So we're just showing you the biggest stock.
This is not a real trade, once again. And if Microsoft declines under 100, we're all in big trouble.
Yeah, that's true. It's a lot more. That's a good example I use. Thanks for scaring everybody out there. All right, so now talk about the gains you can make in this, because this isn't something you're looking for 20, 30% gains. And we're not going to say this isn't, the risk is the amount that you're putting into this trade. But talk about maybe a Starbucks trade, different trade. When things work, how much could you make on these things? Because I've seen 2x, 3x, 5x gains, and you showed those gains, especially when the market came down. But how much could you make if you happen to be right on one of these trades?
Yes, if we do happen to be right, and we get the timing of the trade right, and again, that's what we aim to do. Of course, you can go and make a 3, 4, 5, sometimes more times of your investment. So the Microsoft trade is an example. You just going back to that Microsoft trade, it would have cost you $2 to bet that Microsoft goes down $70 per share, but then your option theoretically would be worth a lot more than that because you're basically it will be in the money if Microsoft does decline to 100. So depending on how much it will decline, you'll make a lot of money. Once you do that, you do it with the good timing, you can actually make more than 100% relatively easily. We've done this several times already this year, and a few of our trades went to much more than that, 200%. And one, I believe, we booked a 500% gain, which was, I'm pretty sure, very helpful when the market dropped.
Now, one question, I want to make this the last question because we want to get to more of this and get to people's questions here live. So, is this the only strategy you use in this newsletter? Because people say, I'm not too sure, if I just want puts in. And for me, I never wanted to handcuff any of my editors because I was handcuffed, meaning that I only was limited to certain strategies. I've been in this industry for 25 years. But this isn't the only strategy you use in this newsletter, is it?
It's not. Once you start trading options, you can bet on the market upside and on the market downside. You can easily do a call trade, almost as easily or as easily as you can do a put trade. When you buy a call, you would benefit from a stock or the market sector going up. It's the opposite of buying a put. And sometimes it's the exact trade we want to do if the market conditions dictate that. You can do a call potentially if you're very bullish on the market, as opposed to every other player out there. You can invest relatively inexpensive, relatively little amount of money for leveraged upside. If you buy a put, that's pretty much the same kind of trade, only the opposite. You invest a relative small amount of money to get the leverage gain from the downside. So you can as easily do a bet on the market direction up or down. It's essentially the same trade. I do think, though, that at this time, people benefit more from having some kind of protection in the form of a put. But that doesn't mean we will have to stick with puts and puts only.
Yeah, it is with volatility and a lot of these things coming back and the market coming back. The strategy inputs too. The timing could be more perfect, I think. And you were doing a fantastic job in this newsletter. You've always been there for your subscribers, which I love and really, really appreciate. I know how hard you work and all the alerts that go out to these subscribers and you take care of them. So I just want to say thank you. Thanks for explaining this. Thanks for joining us tonight. And
thank you
I'll probably talk to you tomorrow.
Talk to you soon. Thank you.
All right. Take care. It's so refreshing, Genia. For someone that's interviewed people for a long time, like say I've done it for a living. I've interviewed most of the people that you see on CNBC, billionaires, heads of states and stuff. When I ask them, describe yourself, they give you like a long list, which is cool. People need to sell themselves, but it's just refreshing to see someone, hey, here's my work. This is what it's based on. And, she's doing an unbelievable job. And at Curzio Research, that's what we want to do. Especially my responsibility when it comes to the analyst is putting the right people in front of you. And sometimes, again, someone's been doing this for a long time. You may think, well, someone that generates great returns. It's not just about returns. You have to be right more than you're wrong. You have to find something else to do. It's about educating. It's about caring, right? Because in order to thrive in this business is you have to establish relationships, right? And you do that by being there during the worst times when things are really bad. Things are good, everybody's okay, everybody's high-fiving each other. For me, for example, Genia, Rich Sutmar. But for me, during this environment, I'm doing daily videos, daily live videos. Curzio Research, YouTube platform, our Twitter at Frank Curzio. Just updating you as much as I can and being there for you because that's what this is about. That's how, I learned how to treat subscribers from my dad. This is my blood. I love to do this stuff. And, I guess any son wants to, look at his dad and say, oh, he's looking down, he's proud of you and stuff like that. And that's a big motivation for me. This is something I'm going to do for another 20, 30 years. I love it. I love analyzing stocks. And just see Genia and what she's doing help subscribers. It's just it makes me really proud. She's like a forensic analyst that you saw me break down the numbers and break down everything. So You need someone like that when it comes to these newsletters, especially with Money Flow Trader. And Money Flow Trader is a fantastic newsletter. It's unique, and it's one of the few you'll find in our entire industry that is run by a former money manager that's going to show you how to make a killing on individual stocks. And her performance is absolutely incredible so far. I mean, she's locked in incredible gains on Starbucks. It was a 150% gain on one of the positions and a 500% gain on another, right? So you only need these things to work out, like a 20% decline, which I showed you. And she's been doing a fantastic job. Bed Bath & Beyond, another triple-digit winner. You look at Teva Pharmaceuticals, was a 125% winner in short term. This is just over the past 2 months. And you look at the market now, and it's gone up. So you're going to see positions in a portfolio who last few trades, not doing that well. But these aren't closed positions. Okay, this is for 1 full year. That's why long dated puts. And I wanted to really focus on that today, where I don't know what's going to happen tomorrow. What's going to happen with a month through earnings season. But what I do know is a lot of these things are going to come down hard. They can't support these valuations, and eventually numbers matter. They do, and they're going to matter. And I'm betting that things not just are not going to return back to normal, but they're not going to be so much better than they were now. The best environment in history, and just see what she's doing on this portfolio is fantastic. So for Money Flow Trader, it's our top selling newsletter over the past couple months. I've been getting lots of calls and saying, Frank, what's the best price you could offer? And we wanted to put together a special deal for you, because this is a newsletter that I don't think, but I know it's going to be incredibly helpful to you. It's going to teach you how to make money on a downside, where just a small percentage, you're going to have limited risk with these things. You're not going to get blasted by going short. Could generate 2x, 3x, 4x, 5x gains, which we've seen from this newsletter just in the past few months. And I think you're going to see those returns a lot sooner than you think. I want everyone to have access to this type of research. This is Wall Street. Again, you don't see a lot of newsletters like this, and I love the job that Genia is doing. So we're going to offer something special. And I love being the boss here, because my marketing department's like, no, don't do that. But when you look at this product and how much we sell it for, and I want to show you right here really quick. So if you go to our website, let me bring that in right here and just type it in, Curzio Research. You go to publications, you're going to go to Money Flow Trader, and if you go to the bottom right here, we sell this for $5,000 a year. So, I mean, that's a pretty hefty price. So right now, if you go to our website, you have to subscribe to this. It's going to cost you $5,000, and you have to call us to get that deal. So the price of this newsletter, we're going to bring it down to $2,000 a year. That's a 60% discount off the regular price. We're also going to include a free options guide. Very, very easy to read. And this is purchasing long dated puts, but there's going to be other option strategies that she uses. That's the focus. We showed you how easy it is. This is how Genia operates, and just showing how easy it is to make a trade, and just follow her advice, plug it in. I did it through an E-Trade account. You could do it through Interactive Brokers, Fidelity, Ameritrade, but it's pretty simple to execute these trades. And also, as another bonus, we are going to give you a free subscription to Genia's Unlimited Income newsletter. This is a newsletter that's in beta version. So the only way you can get access to this newsletter is by subscribing to Money Flow Trader, or by becoming a Curzio One member, which is access to all our sites. But this is in beta version. Genia is an income genius. I mean, this is something she's been doing for a long time. She's run some of the top income newsletters. And I'm going to let you in on a little secret here when it comes to income stocks, because income stocks are going to be the next growth stocks. Why? Because we have zero interest rates across the board. It's going to stay like that for a very long time. We have negative yielding bonds. You're looking at an industry right now that's incredibly dangerous. If you're looking for yield, which a lot of people are, this huge demand for this newsletter. We're going to launch this month. Obviously, we couldn't, right? Because it's been so crazy with coronavirus. So we're going to launch this next month. But you're going to have access to our beta versions. And when you're looking at this market right now, people don't know this, but there's 250 companies, about 250 in the last 2 months, that either suspended or lowered their dividend. And when a company does that, they usually get whacked and they get hit pretty hard. And we're going to see that continue. We're going to see Disney's, the Chevrons, Exxons, and they're trying to protect their dividend. It's going to be very, very tough with oil prices stay at these levels long term. and you need someone like her, a forensic accountant that digs through these, balance sheets and income statements, that understands this market, and someone who is a specialist. Where I've read a lot of income newsletters over my my career, and a lot of people focus on the highest yielding stocks, where it doesn't make much sense for you to purchase a stock yielding 7% if it's not growing it and it's going to provide you with negative 15% returns, right? So sometimes it's better to buy a company yielding 1.5 or 2% that's projected to grow earnings in the right industries during this new normal market. And Genia is fantastic at doing that. So you can have exclusive access to this. So it's not just $2,000 where you get that newsletter. You're going to get this income newsletter. Again, if anybody calls me today, we don't have even a price on it yet. Again, it's in beta version. Why do we do that? We offer beta because we care what our subscribers think. We want to hear your feedback. We love criticism at Curzio Research. That's what makes our products better. I mean, there's a reason why I focus on customer service all the time. You see what the problems are, what people want. We're always looking to get better here. And that's one way to do it, where, we release beta versions of our products. So you're going to have access to that. And also, as a final bonus, incredible value, and I'm sure a lot of you could attest to this, that anyone that subscribes to any one of our products automatically gets access to my Frankly Speaking podcast, which I host every single Friday. It's strictly a Q&A podcast where I'm there for my subscribers. So you never know your question, maybe the one I read on this podcast, where I tell people to email me, frankcurzioresearch.com, put Frankly Speaking in the headline, and you never know that question may be the one I read, but it's I answer about 3 or 4 questions every single week. This goes out directly to paid subscribers. It's an exclusive podcast. It allows me to talk directly to you. And you're not going to find this anyplace other than us emailing you this. It's not on iTunes. I could tell you, I know a lot of your Wall Street Unplugged subscribers, but for Frankly Speaking, really pounding the table, telling people to take profits in late January, early February. Sparks started coming down February 19th. We sound the alarm in Wall Street Unplugged, but Frankly Speaking is where I really provide in-depth analysis. I answer questions on the companies in the portfolios. It's a fantastic podcast. I love to do. So again, and that's something just for subscribers. You're going to get that for free. So $2,000 for the year. That's 60% off. The free option guide, very easy to read. We make sure that it's very easy for you. It makes no sense to sell your product and you don't know how to use it, right? It just doesn't make sense for anybody. So, and also you're going to get Genia's Unlimited Income newsletter, which is, again, exclusive. Only you're going to have access to it. People can't buy that newsletter now. We're going to launch that. Have a great launch for Genia next month. Again, I want to do it this month. Just a lot going on. And then access to my Frankly Speaking podcast. Now, in order to access this, you have to click the link. Just click the link below. You're not going to find this price anyplace else. That's the best way to get it. And I want to tell you something even before you subscribe. My goal here is not for you to purchase a newsletter in 3 months from now, be pissed off and say, "Oh, I can't believe I did that." That's not what we're about here. Once you become a subscriber, you become family, and that's how we treat you here. I'm in this for the long term, like I said earlier, and I can guarantee you one thing about our products here. In our industry, when it comes to our subscribers, we by far, and I would put money on this, that we have the highest percentage of subscribers that after they purchase one product, they purchase several of our products, because they know that our analysts are for real. They know that we're there for them. They will provide research around the clock. We care. And that's a big deal. You say it like it's a given, but in this industry, people don't understand the responsibility when you go on TV and people listening to you. I understand that responsibility. Genia does. All my analysts do. Rich Sutmeyer, where what we say, people are basing their investments. They believe in us. They're putting their money behind us, and I take that very seriously. We all do here, and again, this is about family, generational wealth, and things like that. So again, the goal here is not to say, hey, let's say a newsletter based on a strategy that I'm almost positive is going to work and you're going to do very, very well on, and this is a unique newsletter where you're not really going to find anyplace else. But it's much more than that. I mean, the goal is to get you to subscribe to all of our products, so this way we can help you with all your investment needs, and that's what we're about here at Curzio Research. So, guys, you're looking to subscribe, do so. Click the link below. Very, very simple. Again, you're not going to find this offer anyplace else, and that's for $2,000, 60% off for 1 year of Money Flow Trader and all those premiums. Now, it is showtime. About to take questions. Remember, after I take these questions and answers, I'm going to give you my 2 free trades, and One of them is definitely controversial. The other one a little bit, but looking forward to that. My whole team is standing by right now. This is the fun part. They're putting together all kinds of lists, and I got to show you what they're talking about here because it's going to be pretty funny. But this is just one of these small lists. So these are all your questions that are coming in. Keep them coming in. All these. I'm not going to give you "Are you ready, ski daddy?" like Kramer does, but let's get to this. Let's have some fun, and I'm ready to rock and roll. Here we go. All right, so let's go with the first question is from Jay. Any thoughts on Macy's? That's really the first question on Macy's. So Macy's was interesting today. Macy's just came out and they said that they were looking for. They said we're okay from the liquidity crunch. We're going to be perfectly fine with that, and with our creditors before they raise money, which is kind of weird, right? It's a sign of the times and the environment, which is pretty crazy. I don't like Macy's here. Just a retailer, just really bad right here. So I'm not crazy about it. Let's go. We can do them quick for you guys. Mark asks, Frank, what about shorting the housing market? I think housing is going to be okay this time around. This isn't a banking crisis. Thanks to the Fed really made sure that with the stress tests that these guys are really fully capitalized, which is very, very important. They had enough money to withstand a lot of what's going on. And, the housing market is more about banks and stuff. So I will be shorting the housing market. I think it's going to stay pretty solid. There's equity in the homes now. It's not like it used to be. So it's definitely much better. Let's keep going here. Joe M. asks, what data points will cause you to change your mind with respect to this market? What will destroy your thesis? When I look at that, Joe, and that's a great question, because the one thing is we need to look at the coronavirus as if it's the flu. If we do that, we're going to be fine. And we're very far from that, right? I mean, consumer behavior, we're nervous that people are going to die when now that we're testing, it's 0.2% is the death rate right now. Because now we're testing people who already had it that are not in the numbers. And I told you earlier, the data is wrong. So 0.2% of death. So 99.8% of people right now are staying home because of it. But, again, we throw old people in there, the percentage is going to go up a little bit. But I think that's going to be a big thing. That's going to make me change my thesis. When people look at this and they can go out and they can talk to people, I just don't see that happen over the next couple of years. But yes, I always want to look at when it comes to my thesis of what could destroy that. And guys, in this market, I said it earlier, you have to be willing to change on a dime. So you'd sell the cruises don't look good, but if Trump comes out and says, well, we're backstopping all of them, it changes your thesis. So you don't be a perma bull or perma bear. Really, I've seen that so many times as the worst people listen to, because no matter what market conditions, no matter what changes, no matter what the facts are, they always have the same thesis. You have to be willing to change in this market because the government is going a little crazy here and they're just bailing out everybody. Let's get to Andrew. With the price of oil falling so dramatically and potentially staying low for a while, are there any small and mid-sized oil companies who are well positioned to weather the storm? Or are we just looking at Exxon, Chevron, and maybe pretty much everyone else going bust? I don't even like Exxon and Chevron here, but I can tell you that, quick stat, 47% of the global production is hedged for this year at over $50, which means that's what they're getting, right? It's almost like, Walmart and Target and all, everybody has fleets and stuff like that. They want to, due to the volatility in oil prices, you always want to hedge yourself. Next year, that goes down to 3%. That means they're going to have to pay spot prices, and nobody can make money right now other than, I don't even think the Saudis really. I mean, they say they could produce under $10, but it's pretty crazy right now. The ones that are hedged the most, Pioneer, Devon, and a small one, I'll give you Laredo, actually. Not one I'm crazy about. That was one that I visited every major shale area. But Pioneer, Devon, Laredo, World Dutch, guys, it just suspended its dividend, cuts dividend. You're going to see the same from Exxon and Chevron. I know these guys want to protect their dividend, but it's going to be really tough in this market, especially if oil prices stay low. Get to Sam. Where does someone start from Dirt 1 to the moves that you're teaching? Well, I'm going to assume Dirt 1 means just from scratch, but if you already bought stocks, getting into Genia's option newsletter is going to be pretty easy. The option guide that she has makes it easy. We already showed you how easy it is to make a trade in that. Just got to follow her advice and plug it into, whatever online platform that you have. But if you've never bought a stock before, listen to my podcast. It's for free. Get the hang of it. Don't have a model portfolio, because unless you have real money in it and you're losing, that's when you really care, even if it's a little bit. But you really don't care if there's not a lot of money in it. So you want to listen to my podcast. We have other newsletters that are kind of like starter newsletters that you can focus on as well. Curzio Research Curzio Research Advisory. But that's what I would do. Just read as much as you can, question everything, and that's the best advice I can give. But there's no matter what age you are. I mean, you really want to start investing as soon as possible. I didn't even, I've been in this for 25 plus years, but I really started taking it serious. Obviously, my dad passed away, and but yeah, when it comes to really, starting from scratch, just read as much as you can, and definitely purchase a few shares of a stock here or there. Next question is from Mike. I'm a little confused on companies and the removing of guidance. Is it mandatory that a company gives guidance or voluntary? If it's voluntary, why do you think that stocks are not reacting when the companies do pull guidance? It seems that would be a sign of trouble. I don't know. Pre-coronavirus, if you removed your guidance, your stock, and I remove your guidance. If you lowered your guidance and you're a growth company, you're trading at a growth multiple. So say if you were trading average 17 times forward earnings over the past, 10 years. If you removed your guidance, you would get destroyed. If you just lowered it, you go down 10%. If you removed it, because you don't know if it's 20% less that you're going to see, 30, 40, 50, it creates a ton of uncertainty and your stock will get nailed. In this market, that's a good thing. Just remove your guidance and your stock's going to go higher, right? I mean, you look at Macy's, like I said earlier, that was just, we're talking to our creditors now before our liquidity crisis. Like, who does that, right? It's a sign of the times. I mean, you're not going to say that you have a liquidity crisis before you go to the creditors, right? They're not going to give you money, but that's a sign of the times here. So, no, it's not mandatory. It's just companies that provide guidance, again, certainty, right? That's the biggest thing in this market. That's why I'm very nervous here. When it's a death of all stocks, and I say that is uncertainty. So that's why companies want to provide guidance, because it does give more clarity and stocks trade a lot better off. So we'll see if they go back to that after this year. But right now, it just makes sense for everybody to move it because you're not getting punished right now, which is kind of crazy. Joe M says, Frank, Andrew Cuomo is the governor, not mayor. Sorry, guys, if I said mayor, he's the governor. I'm a big fan of Andrew Cuomo. I think he's doing a fantastic job. I say this a lot, politics aside, even though that's hard to do right in a political year. But I love the fact that he was calling out Trump when he didn't get ventilators. And then when he got them, they were trying to say how bad Trump was. And he's like, look, he's provided all these ventilators. He's been doing a great job. And I love that on both sides when we're talking about people dying here, right, guys? It's a pretty big deal. I understand it's political year. You can get a little crazy later on, but, let's just take our time here because you're going to have plenty of time to really go after each other probably in a month or two. Yes, this is live and my mouth is dry. So, Philip, the Fed funds rate has been below 5% since 2008. I mean, a lot lower than that pretty much since 2010. We have lived through a full economic cycle with low interest rates. Do you think the collapse of the US dollar, extreme inflation, is inevitable? Or are there other possible outcomes? Or is either case too far out for us to worry about right now? I think you answered your question. I think when we see all this spending, one of the best things is gold, Bitcoin. I got questions coming in that I'm scrolling through these things and try to get as many as I can. But you're buying gold, you're buying Bitcoin, store value type thing. That's the bet. But if you're looking at the dollar, people are predicting a collapse of the dollar. It's not going to happen. I mean, you got to put your money somewhere. Where are you going to put it? And it's kind of hard to predict, right? I mean, because as long as that's the safe haven of the world, because it's not gold. We've seen gold go down. Gold go down right when this started and then came back. We've seen 2008 gold got crushed. 11, 12, right? We have negative real interest rates, all things that are supposed to drive gold, and gold came down. But when the what hits the fan, everybody goes to the dollar. Everybody goes to the dollar. And that's not going to change. So the fact that there's so much demand for it means that when we get into this kind of trouble, the government is going to print like hell, like they're doing now, trillions and trillions. So I don't know if I see a collapse of the US dollar, but right now, and I know it's hard because the emotions are flowing and you're seeing we're over 3 trillion now. I think it's going to go to $5-6 trillion in stimulus simply because that's about 25% of our GDP. 21, $22 trillion last year. Again, just breaking down those numbers is pretty crazy. They're going to keep going up. It's just going to keep going up. Every week that goes by, right? Everyone says economy's good, it's a V-shaped recovery, we're fine. Then why does the government keep adding to the stimulus and people still, need this money in small businesses and stuff like that? But I wouldn't worry about it now in terms of what's going to happen, the consequences. We're going to see bubbles. We're going to see lots of, just like we saw with this, right? What happened? We had low interest rates for a long time. Well, that encourages leverage, and we were extremely leveraged going in. Not like a crazy leverage, but our economy is much bigger, so we had much more leverage with these companies. And none of these companies model for a 70, 80, 90% decline in revenues. Nobody does, right? So you're going to see more and more bubbles pop up, and that's why you have the President Trump going nuts because he's talking to the banks, and the banks are ahead of this, saying, "Okay, CLOs, right? Those high yielding debt and usually high leverage loans and stuff. That was a market that I was worried about. And they came out and said, well, we're going to buy high yielding debt. So through ETFs and things like that. So yeah, to answer your question, not to spend too much time on this, we've got a lot of questions here. I wouldn't worry about it right now. Chad W, do you think Lowe's and Home Depot are overvalued? No. These are two stores that are allowed to stay open. You have to realize that when they're staying open, they're taking market share. I've heard, and I've got a great outreach in Wall Street Unplugged. People tell me the Home Depots are reporting record profits. I spent easily over $1,000 in my Home Depot. I mean, everybody's home. I was fixing up the house, or cleaning the garage, doing different things. I mean, when you're stuck in a house for a while, I don't work my what off, but a lot of people are just working on new projects and stuff like that. So no, I don't think they're overvalued. I think they're great positioned. You've seen the housing stats that came out are actually pretty good compared to all the other economic data that's come out. But that's been pretty good so far. Let's go to Steve. Steven S., who is a friend. So let's see what this question he has. Now the Fed has committed to buy, for the very first time in history, to indirectly buy U.S. corporate paper. How would you play this backstop debt? Kind of just answer that. I mean, it has put a floor under so many companies, and the high yielding debt market, these are the companies, even small businesses. If you're looking at small caps has significantly lagged the market. Why? Because most small business owners, for you guys out there, more than 60%, and this is real stats, have less than 3 months of working capital. So if you're not bringing in any revenue, these guys are sitting there. That's why they're starving for these loans right now. You're looking at a lot of these companies, just backstopping the debt. You're looking at oil companies, and even I was like, oil companies, they should pay the piper, right? A lot of these things should go bankrupt. It's not about the oil companies. It's about the banks that have these loans in the balance sheet. So that's why you're seeing it just shore up the market enough and then kind of let it play out, where we're starting to see a few bankruptcies in the oil market. So hopefully that answers your question, Steve. Zankit. Don't have to worry about your last initial on that one. Zankit. Is it time to jump back into the banking sector, especially the too big to fail banks? I would hold off. The conditions for banks aren't good, even though they're well capitalized. Low interest rates hurt net interest margins for banks. So you're going to have low interest rates for a very long time. And where the banks make money, such as investment banks, M&A, you're not going to see a lot of M&A. It's what I'm looking at, even the banks that are too big to fail, you're seeing those loan losses pile up as well. I just don't see the catalyst right now. I see other places working, which I mentioned earlier, compared to banks. One interesting note from today, guys, Wells Fargo came out and said they're no longer accepting home equity loan applications. Think about that for a minute. I mean, are they receiving that many? If they are, that means the money going to individuals and these people. I mean, they're looking to tap credit from their homes because maybe they're running out of money, right? So, if they are, then that's a big deal. But for Wells to come out and say that, I was just, it's you see so many things. I mean, I pointed out how where oil contracts 2022 are at $32. It costs $45 on average, probably more than that. That's the break-even price for shale in the U.S. So that factor, the home equity loans, the oil, where oil is trading actually where it's trading right now. It's just there's so many signs out there. The stimulus coming in of how this economy is so weak, and yet with the market coming back, people think it's done so well, and everything's back to normal. But like I said, in a year time frame, look 6 months, 9 months out, I just don't see it. And I'm not even factoring that coronavirus is going to come back around and we may go on lockdown again, because there's a good shot for that. I mean, I don't know. I would say that there's a 60% plus chance for that. Right? You're letting everybody out of their cages. They're all going out into the public right now. So if they're doing that, you're going to see infections skyrocket again. And that's okay, right? We have to get that herd immunity, which is very important. But anyway, getting back to the banks here, I don't see any reason to buy these, even the too big to fail banks. I think you can hold off. Let's go to Scott. Scott K. I've joined Angel and a few other crowdfunding real estate platforms, and he names two of them. What are your thoughts on those platforms? I don't feel like this should be the largest part of one's investment account, but it should like have a larger allocation than it does for most people. I'm ultimately talking 20-ish, but currently more than that. Crowdfunding sites, 90% plus are all frauds. I'm sorry to say that. I know it's crowdfunding, and people want to have access to the same kind of things that accredited investors have, right? But there's so many scammers in this industry. For example, if you're looking at Kickstarters, you're looking at, I mean, even when Oculus Rift, right? When Facebook bought Oculus Rift, when you're going on these crowdfunding platforms, you're not getting an equity stake. So what happened? Facebook came and bought out Oculus Rift for $2 billion, and people were like, yes, and they got nothing. They got a pat on the back and Oculus Rift, virtual reality device, and said, hey, here you go play with. So you got to be very careful on crowdfunding, because these are people that are trying to raise money without giving an equity stake away. And you know what? I don't believe in that. We launched our CEO token. We got a couple questions on that, Curzio Equity Owners, where we're going to basically be a publicly traded company, and that's going to be available to everyone in a couple of months, right? There's a 1-year holding period. And once you have access to that, hopefully we're in negotiation trades on one of the biggest platforms, and it's really exciting. But that gives you a direct equity stake in our business as we grow, and that's the way it should be, right? That's the way I structured it. So with crowdfunding, be very, very careful, especially if you're going to put 20% in. Just look at the terms. It's crowdfunding. You might be able to get in good deals, but a lot of these guys are using this market to really scam people, and it's a shame, because I know that for the small investor, which we're all about here, Curzio Research, for the small investor, it's you want to try to get into these deals, but unfortunately, even the ones, again, I spend a lot of time in this market, guys, especially with my CEO token. Just be very, very careful. John Kurt, what's your thinking on uranium right now? Positive. I mean, look at price per pound went from 20 to 34. Major move, Kazakhstan. You're seeing cuts. In Cameco, MacArthur, and Cigar Lake. So you're seeing productions cut, and we just had good news on a political front for the supplies in the U.S. Right. So stockpiling and from the government, which is really, really good. So UEC is a good play. I like domestic plays now. So UEC is probably the best play that I like in him. My buddy Amir runs that company. Done a great job. I see him action. Really cool guy. And again, UEC is definitely my pick there. VJ, if one thinks of longer horizon, like 10 years or so, when will one take a position in Disney? Should I take a position now? I mean, I covered Disney a lot. I think you're crazy to buy Disney here. It could go higher. Maybe numbers don't matter and it goes to 60, 70, 80 times. I mean, I put a 40 times, a 45 times. Not me. That's a consensus estimates. There's 2 ounce that came out and said that they're only going to earn like $1 and change, which made it a 60x. So forward earnings. So yeah, Disney's in a lot of trouble. They leverage themselves at the wrong time. I stay away from it. I mean, I think it can go down. Valuation, what I said earlier. I mean, this is a stock that can go down 50% and still be expensive. It's not going to go down 50%. It's Disney. You'll see money flow into this from institutions and stuff, but at least a 30% decline from here. I think it should be trading around $70, and it's over 100 right now. Paul asks, is it safe for options, or is it a safe option to pile into a dividend-themed ETF since everyone will be craving for yield in the near term? Absolutely not. A lot of these ETFs are not even actively run, even the dividend aristocrats. But I went through a lot of these, and this is why it's so important with the newsletter that we're launching, Unlimited Income with Genia. And again, you can have access to that through this deal. It's the only way you're going to get access to it in Money Flow Trader, or if you're a Curzio One subscriber, you subscribe to our suite of products, because it's in beta version. We'll launch it next month. The dividend aristocrats, I looked at every one of them. These are dividend aristocrats. I believe it's 20 to 25 years. Companies that raise their dividend annually every year. For 20 plus, I think, maybe it's 25, whatever it is. Royal Dutch was on there, gone. I mean, people don't know that there are 227, probably even more today. I think I looked about 3 days ago, that actually in the S&P 500 that suspended their dividend or canceled their dividend. So a lot of these companies are going to get hit when they do that. Most of the time that they do. So I would focus on a newsletter like we're going to put out, which is very important, because you're going to see a lot of rebalancing in these things. It's not actively managed. And when you look under the hood, like I did today with Disney, another company is going to have to suspend its dividend. It would be smart for them to do it. It's a bad thing, but it's $3 billion. You could throw, you're not just throwing to investors, and you could probably get away with it now. Your stock's not going to get pounded because everybody's doing it, right? Just like everyone's removing guidance. JD, do I need to be an accredited investor to trade options? Absolutely not. No, you don't. Okay, you just got to fill out it's a margin form, and then you're not even going to go on margin with the strategies that Genia is using. I mean, even the strategy that we use, we showed it was like $200 to go into a trade. Start small until you get the hang of it. I mean, you're going to be listening to Genia and Money Flow Trader, but again, that offer's there. It's I said earlier, it's a unique newsletter, and for me running this company, I always want to provide. I want to give you access that I have, because I'm fortunate. I mean, a lot of even the research engines I was bringing up today, I mean, that's about $100,000 a year I pay for. I could find every supplier in Walmart in about 30 seconds. That's a publicly traded company. I need that, right? Because I'm always looking at so many different things. But when it comes to being an accredited investor, you don't have to be an accredited investor for this, for trading options. So I would definitely research, read her option guide as much as you can, but you don't need a lot to trade options, as we showed you when we showed that example with Genia. Let's get to Joe. What do you think of Apple's results today? Not good. Not good. Tim Cook's all over the place, right? He said V-shaped recovery last week, right? That's what he told the president. The president went out and told everybody, right? Then he says that he's going to buy back. What is it? He added to his buyback, which is pretty crazy. Do you really want Apple buying their stock at 25 times forward earnings when earnings decline, which I showed you year over year from 2008 to 2019? They're probably going to decline this year. And you're not even going to see strong growth. Who's going to buy these phones where their growth model is China? And I'm not even factor in the president coming out today. I mentioned earlier, it's China's going to have to pay a big price, and Apple has big operations in China. So we have to see how that's going to influence them. But when I look at Apple, I looked at revenues and they're saying they beat the numbers by X amount. That's the analyst numbers that they beat. But if you look at sales increased 0.5% year over year. Tim Cook, like I said, he's all over the place. He's like, it's a V-shaped recovery. Things are good. We're going to increase our buyback. But why did you remove your guidance for? If you're that positive, So I was surprised to see that people love Apple. It's a cult stock, but you have to realize it's a hardware company, and it's not easy to sell hardware products when you're in, the worst recession since the Great Depression. So, wasn't too crazy about those results. GWX, what will happen to the mining industry and the overall markets if the Democrats win in November? You know what? I'm definitely the wrong guy to ask about that. So if I would, look at that, what I see so my first stock recommendation in Curzio Venture Opportunities, right? I shouldn't be saying I should talk positive. I'm going to talk negative because I focus on my mistakes more. We recommended a private placement in a gold stock, and it was right before Trump got elected. And once he got elected, I was like, wow, man, my subscriber's going to make a fortune. This is awesome. A lot of people thought the mining industry would do good, and it didn't, because uncertainty is usually good for the mining industry. So I don't know. I don't know if that's going to make it. I don't think it's going to make a difference because the mining industry is going to have more to do with the money spending, and I don't care who gets in office. The stimulus is going to continue. I mean, if the Democrats get in, Joe Biden gets in, he's going to be inheriting a terrible economy, and so the mining industry, I don't think is going to be impacted. The markets overall may be impacted because the corporate tax rate, right? That was a big deal, guys. And it happened in 2017. We're going to go down from 35% to 20% or 22, whatever it went down to. Created a massive profit boom. I mean, earnings were supposed to grow like 6-7%. They grew 20% year over year, which is insane. So, when I'm looking at putting in perspective when it comes to if Biden decides to raise that corporate tax rate, it means that earnings are going to shrink for these companies, and RP ratio, what I've been saying, 24, 25, whatever it is, it's going to go up considerably. So, but there's other parts of the economy, like just alternative energy that'll do good. So let's see what happens when we get there, right? Let's see what happens when we get there. But I don't think the mining industry is going to be impacted as much. Steven says, thank you for taking questions. You're welcome. What is your opinion on investing in dividend aristocrat ETFs during the unpredictable times like these? When these stocks like to take a hit during this time frame, the benefit is a dividend on the back end. What are your thoughts on protecting your money while investing in volatile market? Kind of a question we got already. don't invest in dividend aristocrats. You have to be very careful because if you're looking at some funds are income funds. They're mandated to purchase these stocks, and say if their dividend is 2.5%, if they suspend their dividend based on the mandate, they have to get out of the stock. So it's automatic that they have to sell it, right? So you're going to see a lot of these ETFs, especially if folks on dividends, be very, very careful. Again, a lot of them not actively managed. But what for me, the dividend stocks, guys, are going to be the growth engine. They're going to be the growth stocks of the world. We're going to have zero interest rates, right? We have negative bond yields. And this is why we're launching this newsletter. And we're launching it because we listen to our customers. Our customers, when are you going to launch an income newsletter? When are you going to launch an income newsletter? I've been in the newsletter industry for 25 years. I have to tell you, income newsletters never sell. They don't. And this is a business, and we want to provide that information. In the past year, I've never seen more people want a dividend newsletter. And right now, it's more important than ever. So with Genia's newsletter, I'm pumped. I think it's just going to be focusing on the most important dividend paying stocks. You really have to look under the hood. You need a good analyst. You need a forensic analyst that really looks at the numbers, because you're going to see a lot more of these companies suspend their dividends over the next 6 to 12 months. And unlimited income, again, with that offer that we have with Money Flow Trader, you get that absolutely for free. Mark X, on your recommendation, I purchased WRTC. I was scrolling through. We got a lot of questions. Wrap Technologies made a quick 40% profit before selling. I recently bought back in, and I'm curious what metrics investors should use to gauge the health and potential of a small cap like this one. If you're not familiar with Wrap Technologies, you should buy it at these levels. I own it. I'm not selling anytime soon. I did a lot of boots on the ground research. One of the first people to the stock, so these are in the newsletters, and I think everyone's okay with me giving these away. So this is the first ever non-lethal device that's used, and you shoot it, and it's like a wrap, and it shoots as fast as a gun. And I actually got shot by this device. So it wrapped me up, it put hooks in you, and I couldn't move. Before you know it, the cops are jumping on you. I talk to management all the time, and of course, with what's going on, coronavirus took a hit. But in Europe, and this even wasn't expected, they have supply operations. They have the guy from Taser, one of the founders from Taser, as president. And when you're looking at Europe, in Europe, cops don't carry guns. So, there's whole videos there of the guys swinging knives and stuff like that. And it's hard to taser them. And sometimes you taser them and it doesn't work. Guys just take the thing off. You shoot them with this, you lock them up, and before they know what's going on, you're throwing them on the floor. This is a device that's going to save lives. I've interviewed some of the top police people out there, top commissioners, the chief of all chiefs of police. I've done tons of homework on this and just interviewed them personally, just to see their faces and the emotion. I really got tied to this thing because they're in the field, and no cop wants to pull their gun on anybody, guys. Nobody wants to pull their gun on anybody. I don't care what they say, and I don't care how much people say about the cops. It's not a good situation, even if it's a clean shoot, right? So just to see the look in their faces and those expressions, like, man, I wish I had this 30 years ago, 20 years ago in these situations. It's something that makes sense. LAPD started using it. You're seeing police departments all over the place using it. You're going to see this show up because they call it the Batman device. You're going to see it show up on TV and YouTube. You're going to see 100 million views. It just is out in these police forces now, and you're going to see it used in public. And everyone's like, what the heck is that? That's it. Wrap Technologies, symbols WRTC. I'm in it. I'm not selling it for a very, very long time. And again, ups and downs with this market. But long term, I think this stock is going to be a huge, huge winner. Let's get to the next one. Justin says, any opportunity in Canada? Or is it just a broken country with a broken economy? I don't know. If you live in Vancouver, it's not really a broken economy, right? I would be selling real estate there. The banks are very leveraged. I'd be worried about it, but the mining stocks, right? I mean, it's a mining town, and I think, if gold doesn't go up now, right? I mean, I've never seen more tailwind buying gold than right now. And it's not just short-term tailwinds. It's long-term, lots of spending, and you're going to see money pour into gold, and you're seeing that right now. That's why gold prices are going higher. So a lot of mining opportunities there in Canada. Andrew says, hey, Frank, love all that you do. Thank you for that. My question for you is, have you moved out of Florida yet? I'm a lifelong native down in Miami, and I completely get every single thing you say about the state. Hope you and your family are well. Florida's coming from New York. Going from New York to Florida is really tough because in Florida, people hate to work here. And I cited so many of these examples on the podcast, and it's so funny because people say, "Well, you're making that up," and then when they come in, like, "Oh my god, it's so true." And just last week, I called a guy. We needed, our trees trimmed, and it's a big job, right? $800, $900. Guy's like, "Yeah, I'll be there 9:30." Never showed up, never called, nothing. And you know what? I trying to get used to it. Still not, but that's Florida for you. So what are you gonna do? I mean, the weather's good, right? So you get some positives. Jordan asked, any update that you can provide in the Curzio STO? That's our security token offering. When can non-accredited people invest? Thanks for all you do. It's Jordan. I covered this earlier. This is going to go free trading around July. We plan, I can't say we are, but we're planning to pay a dividend on it, and it provides you an equity stake in our business. And I'll provide more information on that once we get closer to that date. But thank you for asking. We put together a lot of work in that. We're a pioneer. It's like, I don't know. I don't like that word really, but people will say that, we're one of the few that launched a successful security token offering. I think this is going to be the future. This is going to take business away from the New York Stock Exchange. It's a cheaper way to go public. It makes more sense for even for investors. Where your lockup period's only 1 year, and if you invest in a private company, you're probably going to be locked up for 7 to 10 years. And the only way you're going to get out of a private offering is an IPO, right? If somebody IPOs or if somebody takes you over. With this, we're going trading the year from now. So if they want, they can sell their token. I'm hoping that they don't hold it long term because we are growing and things are good. But thanks for asking about the STO. Man, going crazy here. Answering a lot of questions, having some fun. Tyler says, the powder I have on the sideline ready to invest is money that I have saved for my kids' future. I want to put it in growth stock and have a 10-year time horizon. Looking to get 10x returns or bust. Don't tell your kids that. What sectors and stocks would you suggest? That's a tough question because you see kids. I'm like, well, maybe just buy something and definitely invest in some of Genia stocks and unlimited income. You can take on a little more risk in money flow trader, but gold companies, majors have a little exposure to juniors. I mean, it's hard when you're saying, well, I'm saving for my kids, right? So it's kind of like, you want something to grow, but the 10-year time horizon, you're really looking to get 10x in 10 years. Because if you could do that, I'll quit my job and work for you. Those are pretty good returns. You have to take on risk to generate more returns, right? I mean, the goal of investing is to generate the highest returns of taking the lowest amount of risk, right? The lowest amount of risk. That's the goal. That's the goal for every investment, right? So it's very hard when you say looking to get 10x and you're saying 10x or bust. If it's 10x or bust, invest in junior miners and follow my Curzio Venture Opportunities newsletter because that industry is, man, you want to talk about a crazy industry where, a lot of people you can't trust. I've been, speaking at conferences there for a long time. It's been really cool. And, got to know a lot of great people and have great contacts. But I would say, 80-85% industry is garbage. You have to be very, very, very careful. So when it comes to these stocks, 10x, I would say juniors. Juniors make sense. It's from Barry. Do you think the market cover would be a V or a W shape or some other shape? That's a tough question because I didn't pick any letter, right? I mean, you pick any letter. The V, W, you could say we're in a V right now. If the market goes down, well, let's form a W. Who cares? All I know is right now, stocks are incredibly overvalued. They're more overvalued than I've seen almost any time in history. I mean, I've never seen ever, and you could probably go back forever, where we're seeing this high of valuations from a P ratio perspective when we're in one of the deepest recessions ever. You usually see this right before we crash, right? We usually bottom out, trough at like 10 times earnings. I mean, I don't know what valuations are. It's pretty scary, and numbers are going to matter. Eventually, numbers are going to matter. Right now, it doesn't. People can remove their guidance. They get a pat on the back. Stock goes higher. They don't even have to say what's going on, and that's right now. Everyone's fear of missing out, trying to get in. But I tell you, last 2 days of the market, Microsoft reported pretty good numbers. Stock went down. Apple stock, not too good. You're seeing this market top out where a lot of good news is being factored in now. So. I wouldn't be surprised if it really start going down. I think that upside is really, you're leveling off. It's like hitting a top right here. And the fact that Microsoft did report good numbers, they're not as exposed to coronavirus as everybody else. I think you're going to start seeing it sooner rather than later, even though we're going to see more stimulus down the line. So don't worry about the letter. Just I don't know, whatever you think. WVB, pick a letter. But for me, I just look at the markets, and right now they're incredibly overvalued. My guess: what factors do you need to consider investing in the crushed cruise industry? Uh, if the government really comes in and bails these guys out, I mean, cruises are going to be around. They're going to be around for a long time. Cruises, so it's yes, an industry that scares the hell out of people. They're getting locked in their room. The cruises were in the middle of the ocean, and no country wanted them with the coronavirus. But it is going to come back. There are going to be survivors, but to invest in it right now over the long term, you need help from the government. For me, I don't. It's not a necessity. It's more of a luxury cruise, not like the airlines here. So I would just be very, very careful. I mean, you really need to see the economy bounce back. More important, that's a consumer sentiment thing. You really need people to go out there and feel like they're okay if they catch the coronavirus, just like if they catch the flu. When that happens, then it'll be a good time to invest in that industry. And I don't think it's going to happen for quite a long time. Vineet says, what will you do in reading? He's like, how do you get so much knowledge and updates? Your top 5 sources. I have a ton of sources. I have to say, I don't know if I'm going to list 5, but briefing.com, I was pulling up in a presentation, if you could see it. Fly in the wall. Buy one of those services. They're just fantastic. They give you up to date, they provide earnings estimates. They provide calendars, economic calendars. And it's minute by minute, but it's not overwhelming. But they're just giving you the titles. If you want to click it, they'll tell you, everyone's earnings, when the earnings dates are, and then, Apple reported today, and the numbers were, broken down and in bullets of everything that they say. So it's really quick where I can look at that, and that helps with tweeting and stuff, and that helps for me looking just at bullet points and saying, wait, what's going on? Then I'll go into the conference call and transcripts and stuff. But those are 2 services I would recommend. And when it comes to research, guys, please, if I could say one thing: boots on the ground. Ask as many questions. Visit sites. If always think of it, it's I mean, it's a good thing and a bad thing. But whenever I travel, whatever cab I jump in, I'm asking them, how's business? How's things going? I'm always asking people how things are all the time. People love talking about themselves, right? They do. They'll answer your questions all day, and you can just sit there and, it's like a sponge, and you can really get a good idea, especially with our Wall Street Unplugged podcast, we have all these people coming in, and they're emailing me at the same time. It's real-time information, and, to have that kind of information, that kind of network, it provides a significant advantage. And yeah, I gotta tell you, it's helped us and helped my subscribers tremendously, getting in and out of trends like years before people start talking. People talk about 5G. We talked about 5G 3 years ago. So, even though 5G technically isn't really here yet, but briefing.com, fly on the wall, some good services there. Kartik says, Dear Frank, I'm Kartik from India. I'm a subscriber to your newsletter and a keen follower of your commentary. Question: do you see Bitcoin to insane levels of 200,000 to 300,000? What, according to you, is the future of Bitcoin? Take it easy, pal. 200, 300,000. We see $1 million prices. We see, look, when it comes to Bitcoin, Bitcoin was created for this environment. I had an interview with Tom Lee. He talked about Bitcoin on Wall Street Unplugged podcast. Probably the best part of that whole interview, actually. So what was the Bitcoin part? For those of you who are listening, you know what I'm talking about. I don't know, 200,000, 300,000. I know that it has incredible upside. We have a crypto newsletter that we recommended, that we actually, we recommended it a few months ago. So we're doing well in this position, but easily to test its highs of 20,000, 25,000, at least over the next 12 months, 18 months, I would say. Not that I'm predicting a forecast, but it's just, again, it's like gold. The tailwinds behind it are fantastic right now. And with the amount of money that's being spent, and just, it's not going to stop, guys. I mean, forget about the U.S. I mean, the U.S., we know trillions, but Europe is a disaster. It's a disaster. It was a recession before the coronavirus. China was seeing a massive slowdown in growth. Even our numbers weren't that great. We were holding up, but our numbers were actually coming down going into the coronavirus, around mid-February. Earnings were good. We were seeing strong earnings, but the economic data was kind of weak. It wasn't even that strong. So we were seeing a slowdown in a lot of different economic indicators, but you don't go crazy and get caught up 200, 300,000. How about we go to 10,000 first, right? We're at 8,500, and we talk about 15,000. But 200,000, 300,000, let's get not to get too crazy. I see, again, people make those kind of forecasts because it gets them on TV, right? So when I go on TV and when I went on TV, if they ask me, "Hey, you got any comments about Apple?" I'm like, "Yeah, it's fairly valued." They're not going to put you on TV. They want you to say that it's going to come down 60% or it's going to go up 300%, and they'll throw you on TV right away, right? Because that's headline news. So be careful when you see crazy forecasts like 200, 300,000. Wow, getting to a lot of questions. You guys are pretty lucky. Dave says, "What is your best idea for fixed income security or dividend paying stock right now?" IBM. IBM. I mean, IBM's a different company. When people think IBM, oh, they're terrible, they're getting their butt kicked by everybody. I mean, it's factored in. Very cheap stock, growing in the cloud, focusing on its services revenue now. So, they changed that business model and you're seeing growth before all this happened. But I like IBM, things are good under the hood when the company just raised its dividend, and you're not seeing that, from a lot of companies. So, a good dividend, good balance sheet. They raised their dividend just a couple days ago when they reported, and I think it's cheap here. So I think it's a really good stock. You don't see companies raising the dividend and then a year later they're actually going to suspend or cancel them. So that's one name, and again, that's probably one of the names that Genia is going to cover in her newsletter. And you can get that subscription through Money Flow Trader. Next question comes from Karen Curzio. "What time are you coming home tonight?" I don't know. I still have a little bit more work to do, but I know you've been at home taking care of the kids. I've been really working hard to get this done. My team's working hard to get this done. So tomorrow I'm taking off. Have some beers tonight when I'm done with this. And I got the kids. Do whatever you got to do. If you want to get your nails done, yes, this place is in Georgia, not too far. That opened up if you want. But to answer your question, honey, what time I'm coming home? I'll be home at 8 a.m. after I drink a lot of beers. But I'm just kidding. Good job. I like that. Matthew asks, "Are there any junior minors gold stocks that we should focus on, others to avoid?" Good question. When things are good in the junior minor space, these things can go up 10x, 15x, 20x. And things are good right now. And these things are still down incredibly from their highs. But not all junior miners are the same. Gold prices go higher. Yes, a lot of them are going to go higher. But you want to focus on 5 things. You want to focus on companies that have good geography, companies that have good management teams, companies that have infrastructure in place, which is very important because that can cost hundreds of millions of dollars, like lights and buildings and roads and access to water and stuff. Cash. I mean, cash is king right now, right? Cash is extremely important. And just, a whole entire team. This could go also into management teams, but, you want good geologists where some of these geologists just are very bad when it comes to finance and they just spend whatever you want to spend. Regardless, let's drill over there. All right, it sounds good. Let's drill over there. All right, it's millions of dollars, millions and millions of dollars get burnt, and these are companies that don't generate revenue. So you want to own these companies where these are management teams that have been through the tough times and also that brought mines from early stage to production, which only happens in 1 out of every 3,000 projects, believe it or not. And thank you, Rick Rule, for that stat. He says that a lot. He's a good friend. So yeah, those are things I focus on with junior miners. The most important thing is cash. If they have cash, they have a good balance sheet. They do have good product, good project. Those are the ones I'm investing in. But you got to be very careful. You need someone that really knows what they're doing. I think America Tusa to help me in that industry. Jeff Phillips, Rick Rule, Eric Sprott. These are guys that help me tremendously just to navigate this market because it is very, very dangerous for individual investors. Next question, Gary, how's your hip doing? It's doing good. I got a hip replacement surgery. I have to tell you, if you get the chance to do it, which you're probably not going to get to do right now with coronavirus, 100%. Playing basketball, not as much, but I'm okay. But yeah, things are pretty cool. So I'm still getting lots of questions coming in, guys, and you're still here. So let's see. Get some more questions. And let me just check the time here. Hour of questions. Wow, I can see why my mouth is so dry. All right, so you know what? I'll tell you what I'll do. I was going to give away 2 picks, and I said you have to wait till after this. But how about I give away 1 pick now, right? Because maybe people want to leave right now. If they do, they do. That's why I'll hold 1 pick. So the first pick is to short this stock, Garmin. I would do it through puts. I'll send out information to you for everyone that's signed up, put their email address in. Garmin is a company. They just reported earnings. I'm not too crazy about this name. It looks like it's a cheap stock here at 17 times forward earnings. However, those are very optimistic earnings estimates. I don't see this company making their numbers. They really didn't make their numbers this quarter. I'm going to go into uh, really quick here and show you this. There we go, Garmin. I mean, this is Garmin's home site. Look what they sell. I mean, these are products you really don't need, right? And plus, a lot of these are sold in retail stores. You're competing with Apple here. This is a golf. All right, fine. Cars. I mean, automotive sales are down. You're looking at sports fitness. Okay, maybe okay. Outdoor recreation, not a big, revenue generator for this company. When I look at marine, okay, marine might work out. Aviation, no. But when I'm just looking at their end markets, this is a company I think could really get nailed here. I think it has at least 25% downside. I'll show you how to play it too. Everyone's in their email. I'll figure it out in terms of what puts we want to buy. You don't want to short anything. It's kind of crazy with this market where things could go really against you and get really hurt. I don't want to see you get hurt, but is my short pick. I'll give you my long pick in a little while, but let me get this. I'm getting more questions from my team here. And let's keep going a little bit longer. I'm here for you. If you guys, again, it's running a little long here. It's running a little bit late. So let's take a couple questions, a couple more for you guys, right? I want to be here for you and answer as many as possible. So Leonard says, Mohammed Al-Arian thinks that GDP can go down as much as 40% in the second quarter. What do you think about GDP and unemployment for the next 3 quarters? It's amazing, right? Because we're expecting a very quick recovery. And that quick recovery all of a sudden turned into, it's going to be, just first quarter, second quarter. And then went to third quarter GDP, now fourth quarter. I think there's a shot we could be negative all 4 quarters of this year. A lot of people are predicting a rebound in Q4, but I like Mohammed Al-Arian. I've had him on my podcast. I interviewed him. I think he's a great economist. But 40% in the second quarter, man. I don't think anybody has that number there, so that's pretty crazy. So let me see, because I have a lot of lists, and I have my buddy. Again, doing this live, so having some fun here. I have my buddy Larson in here. Larson, you got some questions coming in because he's waving his hand here. Let me see. Again, thank you to my team who's doing all this. So, okay. Look at this, man. This is questions galore, man. You guys got it. Let me tell you something. You guys are lucky to know me. I'm just kidding. Okay, so a couple more questions here. It's how do you place a stop to protect the downside and put option? Again, Genia's going to show you all that stuff. What you're doing with this option strategy, it's hedging yourself, right? You want to hedge yourself in a market, even when it's going up. You want to have exposure, and most people don't have access or know how to make money on the downside. And in a market that's this expensive, that's what you're able to do here. So in terms of put options, you're only going to lose the money you put in. You put in $200, you put in $500, you put in $1,000. And these things could go out of the money. Like if you bought put options in the past 3 weeks, the market's up tremendously. That's fine. It doesn't mean you lost all your money, because if these things come down further, then you're going to be in the money. You're going to make a lot of money on these things. And you only need a small decline here. It was a big decline in a bull market for 8 years, but right now in stocks, especially the travel industry, if you look at the cruise companies, casinos, things like that, you're seeing them whipsaw. Sometimes they'll go up 20% in a day, and sometimes they'll go down 20% a day. If you get a 20, 25% decline in these things, you're not going to make 1x or 2x. You're going to make a considerable amount of money. And that's where you want to put some of your exposure. I'm not telling you to take all your money out of the accounts and go into this strategy. You don't want to do that. So that's why you need someone that really knows what they're doing to really look under the hood in these stocks, just like I did with Disney and Apple. I probably showed you guys a lot of stuff you didn't realize. I don't hate Apple. Again, I have their products. I like Disney. I go there. But these are incredibly expensive, and I brought those 2 companies up because they're industry leaders, and I know a lot of people own them. And plus, I see on TV, well, it's time to buy Disney. It looks good right here in streaming. They're not going to make money off of streaming for the next 5 years. I'm sorry, guys, they're not. Very few companies, no company really makes money off of streaming. Netflix is doing okay. Their cash flow numbers are terrible, but they spend $17 billion. Let's just spend the $17 billion on new content. Think about it. Netflix just raised money. They raise money. Their stock's doing great. Everything's doing great. Their numbers are fantastic. And they're raising money because that's how much it costs, right? When it comes to streaming, it's keeping your customers. Everybody going to Disney right now is fine. That's cool. But in order to keep them, you have to have new content. And if you don't, then you're going to be left in the dark. And there's so much competition here, and it's an industry that has no pricing power. So a lot of people rushing in. It's pretty crazy. Let's see. Someone says, this is Praveen. Please talk a little bit more on the income newsletter. I talked about it a lot. So the income newsletter, Uh, all I know is you're going to see strategies in here that you haven't seen. It's not just going to be dividend paying stocks. She really focuses on stocks that have growth, right? Because a lot of people just look at yield and say, well, I want to buy a company that has 5-7% yield. It's pretty meaningless if the stock goes down 20%, right? So you want to make sure that these companies are growing by paying a dividend. And she's going to go everywhere. Closed end funds. I see some bond recommendations. Uh, so it's going to open the door. Like I said, this is the new growth market to me. This is a new growth market. So dividend paying stocks, but you have to be careful because we're going to see a lot more. Nearly half the S&P 500 companies that pay dividends have suspended or canceled these dividends. Okay, let's keep going here. Questions coming in anywhere. You tired yet? Okay, this is from. Wow, look at this. Warren Buffett emailed me. It was Frank. I love your research, but you are tough to look at. Have you ever considered hiring someone more attractive to appear in your videos? Keep up the good work. I'm sorry, guys. I know. I get it. Larson, you can come in here if you want. You're probably better looking at me. And he says, keep up the good work. I love that he put Warren Buffett in there. It's pretty funny.
You see the email, right?
Yeah. So real quick thing on Warren Buffett, which is really cool. Really quick, sorry. So my dad actually used to go on TV all the time, and he was really big, and just on CNBC when it first started. And Warren Buffett was there one time. And again, this is Warren Buffett when he was popular, but not today, right? Not like it's crazy, and people die to see him, go to Omaha and whatever annual meeting. So I asked him. I said, "Dad, it's Warren Buffett. I see him on TV. Why don't you get his card?" And he goes, "Son, guys like that don't have business cards." So, and then my dad wrote a small book. It was called Awareness of Indirection, and sent it to Warren Buffett. And Warren Buffett signed it and said, "Thank you, Frank. I really appreciate this. You do great work." And I still have that letter. So just pretty cool stuff. I don't know. For you guys, you're probably like, whatever, keep going. Let's keep going. I'm here for you, right? I'm not running out of energy. I'm good. Man, this is over 2 hours, but we're still getting people online, so this is pretty cool. Will a replay be available? I'm not going to be able to stay for the whole thing. Too bad you probably didn't get a chance to see me read your question now. So, Joe, yes, it's going to be a replay available. Don't worry. I'm going to be sending out to everybody with your, everyone that put their email in. So, yes, there's going to be a replay. Stephen asks, why was Tom Lee so rude to Frank? That was kind of a crazy interview, right? I expected a lot more. And I asked him, I said, do you still think Bitcoin is going to 25,000? Because he's quoted at 50 different places. He's like, I don't know why you asked me that. I'm not going to give you a forecast. I was like, whoa, all right, take it easy, Tiger. But I thought there would be more value out of that. I really was. I guess it was because I was kind of excited and he's a big name on TV and stuff. But it turned out that it wasn't really that good of an interview, guys. So, it was okay. He did provide really good information on Bitcoin. He covers it. But I think he was just guarded because people attack him. And I don't know. I wasn't attacking him. I was just asking him pretty good questions. But sometimes that happens when you interview people. Jerry says, you mentioned that your dad predicted 1987 crash. What similarities in his strategies do you see correlating with this one? And what things did your dad do that can be applied right now? That call my dad made was one of the most amazing calls I've ever seen. This is not in today's time where you have a million analysts on and half of them say the market's going to crash and the other half say the market's going to go up. There's about 15 people that people listen to. My dad was one of them on TV. Navalier, you had Jim Cramer was on. Jim Cramer knew my dad well. Was it Gazzarelli? So a lot of names out there out there for old school. And he put in his newsletter 1 month before, and he titled it "Crash." This crash is going to be worse than the previous three, than the prior crashes. And when he did that, we had a small office in Queens. And next thing you know, you had all these trucks. And it looked like it was like a drug bust or something, right? And after that happened, his business really blew up. It was great, and it was cool. But he saw a lot of the debt picture. I have a copy of that newsletter, guys. I'll send it to you. I'll put it on the website. I'm sure a lot of you guys are interested in it. It just shows you how long I go back with this business, right? It's just in my blood. But I can tell you what I saw in this. I was surprised, and I'm not saying this in an arrogant way, that more people didn't see it coming. If you're looking at January, Wuhan closed. China said they're closing. This is January, right? The market started crashing February 19th. Apple, Starbucks, Microsoft. There's about 40 big companies that depend on China for growth. They all said that they're closing their stores. China's the growth engine of the world, right? So our market multiple was at 19 times forward earnings. That's a huge growth multiple, and we deserve that, right? Earnings were going higher, the economy was chugging along, low interest rates, favorable tax structure for corporate tax structure, and everything was fine. But if you take that growth component out, what do you think is going to happen to stocks? So at first, my call was start taking profits, and we did that in our newsletter, where a lot of these companies started getting hit. And at first, it was China exposure, and then when even in January, that's when the U.S. got the first case. We're seeing it spread throughout Asia now, and suppliers. And I said that, wow, this thing's really going to hit hard, man. It's going to be crazy, and it did, and it came down. I'm not one to call crashes. I'm not like calling a crash every week like some people. But we kind of got that one right, and I'm happy because my subscribers were able to save a lot of money, and that's what that was the biggest thing to me. So thanks for asking. Thanks for bringing up my dad. Matt asks, how would you suggest leveraging the Bitcoin? I mean, leveraging, if you're going to buy it, just Coinbase. Pretty easy. Just put your account in there and very safe. They're the leader, and you can buy Bitcoin pretty easily and get in and out, and that's probably the best way. Bill says, Frank, thanks for doing this. What are your thoughts on companies with great track records as investors in a variety of market conditions, such as Berkshire, to weather these conditions? Berkshire is on that list of 143 names traded at more than 25 times forward earnings. What does Berkshire own? Insurance. Not a good business to be in, right? They're giving money back to people because they're not driving cars and things like that. Banks, not a favorable market with low interest rates, tough to make profits. And they went crazy on airlines. The airlines have gotten crushed. So I don't know if Berkshire's at the play I want. I think it's just too expensive. So, a great track record. Yeah, this is Buffett. But the industries they're loaded up on are three industries that are definitely going to be impacted over the next 2-3 years at least from the coronavirus. I would move away from that. Berkshire's supposed to be a value play. Right now it's a growth stock, 25 times plus earnings. And again, they're in really a ton of assets are in three industries that are going to be significantly impacted here. So I'd be careful. Nothing against Warren Buffett. David asks, when are you going to drink your Eagles Super Bowl wine? To your left. So I went to the Super Bowl actually for the Eagles. One of the best things ever. Me and my wife and my buddy Greg, who works for me, and we had a great time. And one of my friends got this. So champions 2018. I'm not going to pop it now, not yet, but pretty soon. We'll see. We'll see what happens. But thanks for asking. Nate says you discussed forward PE a lot lately. What is your thought on the adjustment that would be needed for the fact that we'll be in a zero or less than zero interest rate environment for a long time? That's a good question. Normally, we trade at 15 times forward earnings if you're looking back about 15 years on the S&P 500, right? That's all the S&P 500 earnings altogether, and into one number, and then the P is the price divided by earnings. That's how you get the forward P of what they're supposed to generate. Anyway, so. But when you have other factors, right? So if you're looking back 20, 30 years at that multiple, we had much higher interest rates. A low interest rate environment promotes growth. So that multiple should be 16, 17 times. And it was, right? And then we had a good tax structure, right? Where corporate tax will low. I would say around 17 and a half, 18 times. Maybe about 17 and a half, I would say. It would be a normal rate. It goes up. But we're 25 times forward earnings. That's a big difference, guys. It's a big difference where we are. And that's based on, yes, we have zero interest rates, but that's when the economy is doing good. The whole world is closed. I mean, you've seen the numbers come out, guys. It's horrible. You've seen people on unemployment. Like I said, Wells Fargo just turned down and said, we're not taking any more applications for, home equity lines of credit. That means people are dying, starving for money. And I know a lot of those people who are great people that were doing well, probably 4 or 5 months in the bank, and now they lost their jobs, and it's pretty crazy. It's pretty crazy right now. So I feel bad for them. A couple more here. Just a couple more. So Brian says, Frank, I understand you being extra cautious, and I get the risk is tremendous, but I believe you're not thinking enough of Donald Trump. My thinking, half the audience just went, oh shit. My thinking is Trump's going to pull out all the stops and pump the markets going into election time to get reelected. I can tell you one thing. If I was Donald Trump's campaign manager, I would tell him stop with the stimulus, because what he's going to do is he's going to push this market up another 10% over the next 2 months, because he's going to try to backstop everything, and then this market's going to crash going into November. He's going to lose an election. You got to save some of this. I know they could print as much money as they want, but you don't have to bail out everybody at the same time. You just say, okay, here's money, here's $1 trillion, here's it. We went from 250 of small business loans to 450 to 750, and we're going to go higher. This is like 3 weeks. 3 weeks. That thing was gone in 5 days at 250. So it doesn't matter if it's Donald Trump. Doesn't matter if it's the Democrats. You're going to see more money get pumped into this market. But the markets right now are really pricing in perfection, guys. And again, people say, don't fight the Fed. And you're right. You don't fight the Fed where it's 2011 and the PE ratios are 10, 11. Don't fight the Fed. Everything's going to go higher. But you don't fight the Fed, it doesn't mean that stocks are going to go higher from 22, 23 times forward earnings. I mean, these companies eventually have to earn, right? That's what generates them. Let me tell you something. A big deal is buybacks because everybody accepting money is now allowed to buy back their stock. That has been a massive factor in earnings growth. $1 trillion is supposed to be in buybacks this year. That's gone, right? That holds up your stock. That increases earnings. If Apple didn't do that, Apple bought back billions of stock and they still couldn't get their earnings to increase year over year from 18 to 19. That's why they're buying back their stock. They need to get their earnings up because they're seeing slower growth. Apple could do it. They have the best balance sheet, right, in the whole world. So most companies don't, but you're taking buybacks out of that equation. Again, that's another catalyst that was really fueling stocks that's no longer there. So, pretty crazy. A couple more here. Ryan says, you've been coming down hard on streaming services and companies lately. Can you explain why? Why have Disney, Apple, Amazon, and others gotten into what appears to be a bad business? Isn't this a good business to be in during a global quarantine? Yeah. Are we going to have a global quarantine forever? I don't think so. And even Netflix actually said that. So there's a difference. Amazon, Apple, these are companies that have amazing business models that are saying, okay, this is going to be a small part of our business. Disney said, this is it. We're going all in here. And why did they do that? What does Disney want? The secret to the best business models are recurring revenue. So if you're looking at companies with cloud, right? If you're looking at the Adobe's, Microsoft's, the Amazons, right? These are cloud-based companies. Constant revenue coming in, fees constantly coming in. AT&T and the cable companies and things like that. Yes, AT&T is into streaming. Cable companies are going into streaming, but they also have those checks coming in from people paying the services, the AT&T wireless services. I mean, that's why they generate over $20 billion in free cash flow every year, AT&T, and even Comcast, tons of cash flow. Those checks come in every month. Disney doesn't have that. So it's a good business as this is one component. But when you're really going all in, where 25% of your market cap, over $70 billion Disney spent top of the market to buy Fox Entertainment assets, in an industry, man, that it's really, really hard to make money where you constantly have to spend. You got to just hire the actors and just all these studios. It's really a tough business, guys. It really is. It really is tough. Okay, let's see if we have a couple more here. This is from Kathy. Would love to see the format of the Money Flow newsletter. How often is this update? How many stocks? Often it's communicated. She does a great job. She sends out alerts like crazy. And you're going to see lots of trades in there. So in terms of the format of it, you're going to get constant trades. You're going to get constant alerts. And what I love about it is even if trades don't work out, and I think that's a big part of the business, right? Where you always want to be there for subscribers. I mentioned that earlier, but just to see Genia when things don't go well, and positioning doesn't go your way, which look, it's going to happen to all of us. I don't care how great you are. You want to be there. I mean, people just want to be told what to do. For me, being in this industry for 25 years, it's okay if you have losers. What really pisses people off, if you don't say anything, you don't even acknowledge it, so you have to acknowledge that. I mean, say, hey, listen, this is on me. Let's get out. This is exactly what we're going to do. Don't worry about it. Try to make this back someplace else. That's the way, that's what a real newsletter editor does. You don't just, oh, this one's down. You don't update. You got to let know people what to do. That's what they're paying you for, right? So Genia, I love that fact. I mean, just that's, again, I got lucky with the hire. And again, one of the best analysts that I've worked with, saying a lot compared to, if you look at all the people that I've interviewed over the past 12 years, I've been in this industry for 25 years. She really knows her stuff, and she's really, really good, guys. Okay. Man, I think that's it. So let me see. Can we get one more in here? All right, one more from Tucker. Will Genia ever do multi-leg option trades like straddles, collars? Love to learn that. What I didn't want to do with this newsletter is handcuff anybody. I was handcuffed with a stocks under 10 newsletter only, so I can only pick stocks that were under $10, which is frustrating when I was at street.com. When I'm a small cap analyst, when I covered all the markets. So with her, I said, look, we want it to be a long dated put strategy, to buy puts, but I don't want that to be 100% strategy. So if she sees things, I mean, she's recommended gold, different option strategies and calls. Yes, she'll educate you on that. And you might see some of those strategies, but it's not just, that's the theme of the newsletter. But you're going to learn a ton about options. Again, people are scared of options. People are not crazy about them. But if you do it smart, if you have someone helping you, holding your hand, the education that you're going to get, not only are you going to be able to apply to all positions of Money Flow Trader, which she's going to tell you how to do, but you can apply it to your rest of your portfolio, right? I mean, there's going to be stocks that you own outside of the ones that, I'm recommending, Ginny's recommending, Rich Stutmeyer is recommending, our editors are recommending. So, that's the best way to play it. So, wow, 2 hours and 25 minutes. Holy cow. That went by pretty fast. I know, actually, we still have a lot of people on, but we have two things here. One is I want to give away the other pick, and the other pick is to buy Google. I'm kidding. Imagine I gave that to you. At the end of the day, you guys would kill me. No, it's not. The pick is, here it comes. A little controversial, but I'll tell you why. I'll bring it up here. Let me bring this up for you guys. Is to buy Southwest. I know. The airlines, I could be buying the airlines. Southwest I like. It has one of the best balance sheets in the industry. What I like about it is when you're looking at the loan terms, which I really dug into, guys, these guys, Delta, really stood out tremendously. When it's a company that, look, even the forward PE, and again, even if you cut those earnings down, it's not too bad. They do have a very, very good balance sheet. $5 billion in cash here, $6 billion in debt, but they got a very solid balance sheet. And this company in particular, when you're looking at the terms of the loan, which is my job to do, the $25 billion that they gave, but it's $50 billion, but they pushed out $25 billion. So far, Southwest got $1 billion of that. Those loans are 10-year loans. So the first 5 years is only 1%. The next 5 years are just 2%. The terms that they got are favorable. They're one of two airlines other than Delta. Everybody else was forced to give away warrants to the government. They didn't have to, which is good. This way, it's not going to result in dilution. The airline industry, guys, is a good industry. I know there's a lot of people out there, and I'm ending with this, and they're going, "What are you, crazy?" Hear me out. I mean, I take Delta all the time because their hub is very close from Atlanta, so I get on all the new flights, But they've been through this, a lot of these airlines. They've been through the bankruptcies. They know how to cut costs, and it's pretty bad right now. But the airlines are a necessity. These guys did the right. They were trading at single-digit PEs, buying back their stock. Increasing those earnings. That's when you want a company buying back their stock, right? I mean, they did very well for their shareholders. They would generate tons of cash flow. I mean, you look at these businesses, they went from uninvestable, like Warren Buffett said, to going all in, right? This is Warren Buffett, a value investor. These were cheap stocks growing faster than the overall market. They're doing everything right. Nobody models for 70, 80% declines. This industry is going to bounce back. There's people that are going to be dying to travel. I don't think it's going to take too long. You're not going to have to see full capacity for these things to go higher. You're looking at Southwest is still down 50% from its highs. I think we could easily get 20, 30% gains out of this pretty much by the end of the year. But one of the things I think is going to happen, I wrote this in my newsletter today to Curzio Research Advisory members. I think the government's going to take an equity stake in these things. I know it's crazy and it pisses you off, but you know what? I'd rather they take an equity stake like they did in the banks in 2008 and 2009, it's taxpayers' money because it's going to put a floor under these things and really take off. Either that or they're going to provide more stimulus because the airlines as a whole generated $300 billion last year. $50 billion is really not going to do anything, right? So at the valuation, I think a lot of risks are priced in, expectations are low. Southwest is one of the best in terms of their balance sheet in the industry. Again, they got favorable loan terms that's my pick, and that's my long pick. I know it's a little controversial. You're looking at the government. If they do take equity stake in this thing, it's definitely going to put a floor under it. And that resulted in the government making an absolute fortune. And right now, what the government is doing with our taxpayer dollars and throwing trillions, they're just giving it to people, and people are just going to be paying their bills right now. If you want to short up the markets, the balance sheets of the banks are fine, but the cruise lines, if you really want to, take equity stakes in them. And, the government can do whatever they want. And they actually said, Janet Yellen said, you know what, they should be doing that. I don't agree with it. I hate it. But this isn't about, what you like and what you don't like. I mean, if you hate it, you could hold up a sign in front of Washington and say you guys are a-holes or whatever you want. The bottom line is my job here is to make you money. And with the airlines, I think you can make really, really good money over the next year, over the next 2 years. And for everybody listening, we're going to send you these trades if you put your email address in, and we'll push them out to you. Last thing here too is that offer. If you're going to take us up on Money Flow Trader again, I'm hoping that all of you do. And my goal, like I said earlier, is not to sell you a newsletter in 3 months. You get pissed off at me. This is a newsletter I think is going to help you tremendously. It's a newsletter you're going to have trouble finding out there in the whole industry. And right now, I've never seen better times. And I wouldn't be selling a product and putting a product in front of you that I didn't think you can make a lot of money on it for the next 2 years. I've seen that done in marijuana at the top. I've seen it done in crypto at the top, and people get buried. That's not how you build a 20, 30-year business. You need to take care of your clients. So at this price, you can get this discount, which is very, very big. We usually don't offer those types of discounts for our back-end newsletters or higher price newsletters. So if you're interested, do it now. If not, that's pretty cool. That's fine. Listen to Wall Street Unplugged. If you're new to this, you listen to me the first time, do your homework on me. Do your research. Go to my Twitter account. Go to our archives. You can see everything that we were saying this whole entire time, especially the coronavirus. With great developers who put that together and a great team. But that's your job. Do your due diligence. Make sure you're following the right people, and hopefully we can get you guys subscribers, because at the end of the day, that's what we want, right? We have a really good following. We have people that we care, our analysts care, and it's really cool right now. And I'll end with this, because you're seeing me on this camera right now, and you see my name on this thing. This doesn't happen without my team. So there's people staying up right now very, very late. There's people that are working around the clock, 1, 2 in the morning to get this done. I mean, putting this together, in such short notice, again, no prompters or anything. I'm going off the fly here. I don't care about making mistakes. All I want to do is try to help you guys, but none of it works without my team. And you need a good team, and I have one. So I just want to say thank you to them. And if they're sending you emails or anything, just be sure to thank them. Again, you see my face, you see my name on it, but none of that works without everybody coming together, and everybody really worked their ass off to get this done. And I hope you enjoyed it. Hopefully it wasn't too long. We love the criticism. So frankcurzioresearch.com. Let us know what you thought about everything, because we want to definitely put a good product in front of you. We want to put a good service in front of you. And the only way we could do that is by listening to our clients. So let us know what you thought, and I'll report back to you guys soon. Take care.